develop?
You're scary, bro.
I know.
Ryan's here, Chase is here, Jose Pablo's here, Ramon is here. Jacqueline, I meant to tell you the other day, just so that you know, when you cut and paste, if you transpose using paste special, it's not an array. So it's a one-time. So if you change wherever you transpose from, it doesn't transfer.
Okay, yeah, I figured that out.
As long as you know that, okay?
Is that for me?
That was kind of my question.
This one's true.
Those things that are space, that are horizontal, but
I think so, it'll just copy the space.
well, I guess without copying the space. Like,
Not that I know of. You probably do conditional space.
you know what I mean? Like, just you took the yearly occupancy and it's spaced out by 12 months to a vertical chart that doesn't.
No, but you know what you could do is you could do like a lookup table, or you could do a lookup, and so every time it hits, you know, whatever value.
wanted me to put something together.
I just did one for the first time the other day on something else I'm working on, so I don't.
I've never used it.
No, I used it for the first time this week, so, you know, it actually, that could, well, actually, that, you would have to put subtotals there. See, that's another way you could do it. You could put like subtotals at the end of December and then just,
Yeah.
it's, Naisha, I know is here, I haven't, Alec, I know is here, I don't see him, John O'Hara, Juliana, you're here, right?
Yes.
Judson, I don't see, Andy Schneider's here, Sam, I don't see, L'Oreal, I see. Good afternoon, everyone.
Good afternoon.
Good afternoon. I don't mind seeing food. No phones, please, no computers, things like that. I hope you all had I hope that you all had a nice Thanksgiving. I hope that you enjoyed your families. Hope you ate a lot.
Let's start off strong with treasuries. So the
You started off strong with treasuries. What's it?
the 10-year treasury. Yeah, because no, I had a question though. Like,
What's the 10-year rate today, though?
186.
No, I think it's just like.
Did you just get it wrong? You just like.
It's like 183.
Yeah, come on, man.
I was
Rookie mistake.
But the I was watching
Well, we have a question, folks.
I was watching an interview with a guy who says that he's long 10-year treasuries right now because he's saying that incremental moves in the interest rate now will beget higher returns as opposed to like say 10% when it was back there was earning 10%. If it went like 10 to 8, like the capital gains on it going from 1.5 to like 1.2 would be
Well,
more substantial.
Right. So, I mean, the thing you have to think about is there is an inverse relationship between interest rates and bond prices. So, if bond rates or yield go up, bond prices are going to come down. So, to be long a bond with the expectation of a capital gain doesn't work.
But what he's saying is that the small increase, since the interest rates are so low, that the interest rate moves are more substantial. Like in terms of bond pricing.
So there is you can do that. You remember that chart that I did? You could do that parabolic view, right? So there's something known as convexity, okay, or duration, and those are the specific relationships that exist between bond prices and yield. And it's not. I think I said that in the video. It's not a linear relationship. It's curvilinear, okay. And so, in fact, movements in yield don't correspond dollar for dollar to price, right? And there's that sort of parabolic view, right? So, look, this is like math, man. That's like, you know, like an asymptote in calculus. I don't remember any of that stuff. But you can, in fact, predict using convexity or duration what the actual price is going to be. Now, I think his point is that 10 basis points change on a 1.2 yield is proportionately much larger than 10 basis point change on a 5% yield, right? And so any kind of change today is going to move things, but if you're long and yields go up, the value of your bond is going to go down. So you're not going to get a capital gain in that. You'll only get a gain to the extent that your long and yields come down.
Yeah, he was saying that he doesn't think that interest rates are going to go up.
Brian? Thank you. He doesn't think that rates are gonna go down.
Oh.
He doesn't think, yeah, and that's, you know, some people gamble on that. That's absolutely right, so.
Yeah, so he's like trading. That's what you said you were doing for a little bit.
I mean, at some, well, all I have are, I just buy treasuries as a replacement for cash, and that's just a security perspective, okay? The yields you get today, you could put in a money market fund. You know, the problem then becomes just security, right? A money market fund's not backed necessarily by assets that are risk-free. And in fact, we had in 2008, 2 or 3 money market funds that went, you know, what they broke the buck. They broke their net asset value. So you could lose money, they're not insured. So, but my personal thought is I don't think, I mean, interest rates could go down, but I don't think they can keep going down forever. And there's, you know, just the implications of that. There was an article, I think, in the Journal this week saying, you know, the IRS is like kind of in a bad way, because when you don't pay your taxes and you have like, they hit you with a penalty and with interest rates are so low that like when they hit you with an interest, it's not really like a penalty anymore, you know, so like they have to rethink the way that they penalize you. So, Cole, I don't know the answer to that. I don't know. I can tell you, it is intelligent to play bonds long if you believe interest rates are going to go down. I mean, that's when you're going to get the capital appreciation. And some people have made a lot of money over the last 15 years doing that. Now, how much further they can go down at a 10-year yield at 1.7, how much further can that go down?
How liquid are they? Like, if you
Oh,
want.
that's like incredibly liquid.
Really?
Treasuries. Corporate bonds are a little less so.
So would you advise us, like, as students, to be buying the 10-year instead of holding money?
I wouldn't advise young people. I'm not an advisor. I'm not a registered investment advisor. You can turn the darn thing up to answer that. You should. What you should do is whether you go to Schwab or E-Trade or any of these things, kind of take a look at portfolio builders. They all have tools. The rule of thumb is that when you're young, the preponderance of your portfolio should be equities. And then as you get older and you need income and you can't risk as much, then you shift the preponderance of your portfolio to bonds. Remember, bonds are secure, well, can be secured, right? There's different risk levels for bonds, but a 10-year treasury is risk-free. A AAA rated corporate bond is relatively risk-free. I mean, there's typically security and there's different types of debt instruments, right? You can buy mortgages which have collateral, right? You have security. And equities are the residual value, right? The residual of what's left over in a liquidation after all the creditors have been satisfied. So the equity's a lot riskier. But when you're young, you can lose everything and you still got a bunch of years to make it up. When you're old, if you lose everything you got because you played with equities, right? How do you make it up? That's the argument I have. My mom's 83. She's like, well, I want to buy some of those stocks you buy. I want, you know, I'm not getting anything on. I'm like, yeah, but if you lose your money, then like, what do you live off of?
You?
Oh, really?
Yeah, I guess.
You got no spare house. I mean, she
And she can't do the stairs. There's too many stairs.
No,
I mean, she
just
can do
first
them,
floor.
but you know, it's like,
Yeah.
we can manage the first.
yeah, you know, not up.
Yeah.
No, I mean, but you know, and but it's interesting. You know that crazy guy Jim Cramer that's on the Cramerica or whatever that. What's that show?
Fast Money or something?
Not Seinfeld. Not Kramer, dude. I've never seen Seinfeld. Jim Cramer. Mad Money. Kramer. Seinfeld. Okay. Dude, there's a generational divide here that goes. Jim Cramer is a guy who used to work at Goldman, and he's one of these pundits on TV. He's got a show on CNBC called Mad Money. You know, and he's always yelling and stuff and giving people advice. And people call in. And somebody called in and said this week, you know, should I be buying bonds? I'm like 54 or something like that. It's like a mid-50s guy. And he goes, with yields today, I'd recommend buy high yield and less risky stocks like utilities, for example, or REITs, and don't really get into bonds till you're 60. So it's an odd time to buy bonds, Cole, because with rates so low, you know, again, my view is that the likely tendency is that they're going to go higher, and if they don't go higher, they're really not going to go much lower. So you're not going to get a huge capital gain by buying bonds now, and the yield is peanuts, you know, is minute. So just a thought.
But the
Yes.
New York Fed just did another round of QE, but they didn't call it QE. And if they do a couple more of those, don't you think that the risk rate would go lower, so that they don't have to take so much money back?
Yeah, I don't know that it was the New York Fed or it was the Fed in general. And what they did is what we talked about the other day is they did what are called open market operations, right? They went into the market and they provided liquidity, right? And in particular, and this is an area beyond, I'm not a banker, okay? I don't follow the money markets that much. What they did is provide liquidity to banks that did not want to go to the discount window to borrow, okay? So what those banks did is they sold treasuries to the Fed under what are called repurchase agreements. So I give you money, and then you loan me or you give me this treasury with the right for me to put it back to you, right? And so what they did is they just created a lot of liquidity. Yeah, again, I'm not an economist, right? I mean, there's the whole Milton Friedman, you know, velocity of money. The more, right? If I have $1 and you sell me candy, and then you buy, you know, whatever, a wrapper from Sam, and Sam buys sugar from you, right? The quicker we can move that money around, we might all be millionaires if we can move it around quickly enough, right? I mean, that's kind of, you know, if we're all buying from one another, moving money quickly, that's the whole concept of velocity of money. There's a lot of theory there too, you know. So, I'm an accountant. I'm not, you know, I'm a finance guy. You know, we don't live with hypotheticals. We try to live with reality. So, any general questions, Scott? I want to cover a lot of material today. Okay, we've covered a lot the last couple of weeks, and I'm gonna roll back a little bit. Okay, I want to roll back. Work. We move quickly, and we got to do like a crab, right? We got to take a step back and maybe reflect a little bit on work. I spent a lot of time this week trying to figure out how we can make this class better, how I can help students learn more, how I can facilitate your process. And some of our reflection was, you know, targeted around, you know, are we overly ambitious? Are we covering too much? And the conclusion I get to is no, we're not. I mean, I think this is appropriate material for a graduate course. I think it's definitely material that will benefit anybody that wants to work in the real estate industry. Now, some people are going to need a very granular view of this, much more so than others, right? So if you're more on the design and, you know, creative side, you probably don't need all these Excel formulas, right? But if you're going to be an analyst, even if you're going to be a project manager somewhere, not only do you need to use Excel, you need to understand the way these concepts work, right? I want to just review what we've covered this term, and then I kind of want to get to where I thought we had a good baseline generally across the class with multifamily, and it seemed to sort of crumble with hospitality. And I've got some theories behind that, but it doesn't matter why we got there. We're there, and then it seemed like we went from hospitality and all the wheels came off. And so I want to frame it, because at the end of the day, what's important, I think, is to understand concepts. And I think sometimes we've gotten overly focused on, well, let me copy his formula while he's doing that, as opposed to understanding what the flow, right? So how do numbers move? So, you know, I'm coming from Key Biscayne to Nova. Okay, what's the route? I don't need to know the route. I know the route, but I'm looking for, you know, the problem somewhere, right? So I know generally I can follow my main routes, right? Then I can get a little bit more granular and start figuring out, do I turn here, do I turn there? But I know I gotta go north first, okay? So let me go north first, let me get on a major artery second, right? And then I can start figuring out, well, do I get off on Hollywood Boulevard and go to 72nd like I had to do today, or do I keep going up the turnpike and get stuck, okay? And I'm going to follow the video sequence because that's really where I think the work related to the modeling, it really came in. I think in the future, maybe we had a textbook originally spec for this class that was strictly modeling, and Dr. Forgy, I think, being sensitive to cost of textbooks, said, well, why don't we just use the one we're going to use for finance, and he assigned some chapters. I think in the future, maybe it's too ambitious to try to cover some textbook material and try to do all the modeling, so that definitely robs a little bit of time, but there'll be time to reflect on all that. And I'm going to go down a chronology of the way we built, because I think the way that the whole video and the whole rolling out of the modeling worked, there were concepts that were exposed, and then they were applied. I've looked at the way this course has been taught in the past, and not to be critical, because we all have different ways of working. I'd say probably most or not all of the concepts that we've exposed today have been covered in the previous versions. But what I've tried to do is put them in practice. So it's great to know the time value money formulas in Excel, but I think it's more important to put them to use in a model. So, and it's okay to do a 3-year model that you get from a template that the textbook sends you. I think it's much more beneficial to build your own model that's 10 years that simulates what you're going to do in the real world. So we did video 1 and 2, which are really just Excel basics. I think most of you have gotten those concepts down. And then we did some Excel etiquette, what I just called etiquette, financial reporting etiquette. And some of you have gotten really sloppy with that again, right? So I see numbers that have pennies, and then the next line doesn't have pennies, or I'll have like dollar signs on some, stuff gets doubled underscored in the wrong place, things don't get underscored, and just stop to think, if you're submitting a proposal to a client, they're going to look at a bunch of stuff. You need to facilitate the review, and I'm going to put myself in the view of a client. I received 21 submissions, right? If I look at a spreadsheet, right, how do I quickly identify totals? How do I look for, so if you don't use the sub-scores, if you don't use highlights, if you don't create open space, if you don't highlight things, it becomes very difficult to follow things, right? If you leave spreadsheets, I still last night got some spreadsheets like, what do you want me to look at? Let me not look at anybody. I got a spreadsheet that said, look at our hospitality model, and it's opened up to a multifamily model, and I'm like, so I'm looking through it, I'm going, this thing's FUBAR, man. I mean, that. And then I realized it was another tab, and I was just in the wrong tab, So, guide your viewer to what it is that you want them to understand, right? So we kind of went through that. Then we went through some basic financial concepts, okay? And I know we went with those early on, and we've been bringing those in. So we talked about things like loan to value and coverage ratios, which are probably the two most critical things to contemplate when we're thinking about leverage in a real estate project, right? So I covered them prior to covering models. We ultimately rolled them in, but the idea was to establish a baseline to say, okay, here's a concept of how to calculate something, but it's not that, it's not to calculate something, it's to figure out once we've got a model. So, you'll see the video that you'll have, it's a very brief video, and I'm going to go through it in class today. The one for next week, when you look at debt service coverage, the reason that that's at the bottom of the measures of performance is so when you're evaluating talking to a bank, right, how does the modeling process work? You think you want to buy something, you gather some information, you put a model together, and you use a bunch of assumptions. Some of it may come from third parties, some of it may be your own database, some of it are just things that you're thinking through. So I'm going to say, I know that more leverage is good, so let me pile on 80% debt on this, right? But if I look at my debt service coverage ratio and it doesn't cover, if I don't have a minimum of a 1.2 or 1.3 in every one of the years in the model, No bank's gonna give me that kind of leverage. There's a reason why we went through all of those things. So, you know, we defined, we first talked about just general business, and then we kind of focused in on real estate. We talked about gross profit margin, and when we talked about gross margin, that same concept came up in the hospitality model, right? Because a hospitality model has a bunch of operating revenues and operating expenses that don't have to do with traditional real estate operating expenses. So they do have a gross margin, okay? And we talked about net profit margin. We went through the whole DuPont model. We talked about return on investment, return on assets, and return on equity. And then I'm going to jump for a second. We paralleled those into real estate. So we talked about things like cash on cash return, right? We talked about unlevered or levered return. We start thinking about things like, in the real world, people talk about ROI, ROE, or ROA. In real estate, we use different terminology. Earnings per share, price earnings ratio. In real estate, we don't use a price earnings ratio. We use kind of an inverse of that. We use cap rate. And we use that cap rate to capitalize an income stream as a perpetuity to derive a value, which could be a value that we buy an asset at, or a value at which we sell an asset at, okay? So, I mean, these are concepts that we've taught, but it's not like, okay, let's do a quiz and calculate cap rate. No, I want to use cap rate in a model to figure out what I should pay for something, right? You know, or what I can afford to sell something at, or by selling something at a particular rate, what does it do to my return profile? Or by selling it in a particular year, what does it do to my return profile, okay? We talked about dividend yield, payout ratio, and then debt to equity, which is the whole loan to value. And then we kind of also talked about, you know, the important thing in any operating statement. It doesn't matter what industry you're in. It doesn't matter what you call it. If you want to call it a statement of operations, you call it an income statement. If you want to call it a profit and loss statement, if you want to call it a cash flow statement. But and we can have a gazillion different subtitles, but we have revenues, and we have expenses. In real estate, those two give us what? NOI. NOI. And from that, what do we subtract? And what else do we subtract?
Debt service.
Debt service, because, okay? Because we're going to assume that every real estate transaction really is always going to have leverage. It's always going to have leverage. You've seen in some of the models, if you look at 10% leverage, there's no return. 10% leverage is like an unlevered, you know, so you really want to juice up your returns. That's the one place to get value, right? And then what's this going to give us down here? Well, I'm going to call it free cash flow, okay? Distributable, whatever, some sort of, so we're looking to measure cash flow. We're looking to measure cash flow from operations, and we're looking to measure cash flow that may be available to distribute. That's what it's all about. At the end of the day, that's all it's all about, right? So we could draw relationships by looking at this, but every model that we've built is this. It doesn't matter if it's multifamily, it doesn't matter if it's hospitality, it doesn't matter if it's retail, industrial, or office. They're all the same thing. Now, each asset class has its own nuances, okay? And I'm going to go through that in a second. But the single biggest area where we differ, or where we have differences, is in the revenue stream. And it shouldn't be surprising to you that we started with multifamily. That's the easiest income stream to understand, right? I have X number of units, they have so many square feet, and I can charge so much rent. Some of the other asset classes are a little bit more complicated, but the concept doesn't change. What's a lease? The right to use space for a specific period of time, right? So that's what our income stream is. And the only difference that we presented, especially in the last three this week, when we talked about retail, office, and industrial, is that they have a different income stream, or the income stream is different than for multifamily and hospitality, which well, hospitality's daily and multifamily's annual. So in a way, they're easier to understand. But, so, you know, we took a look, and then ultimately, we looked at something called net present value and IRR, right? And so, we kind of started putting those into practice. We, in video, video 3, we started, video 3, and in video 9, we started to put a time series of these, right? And we started taking the cash flow that was available to us, and then putting into value putting into practice some of the time value of money concepts that we've learned, right? So if all of a sudden, this is year 1, and then this is year 2 and year 3 and so on down, right? We could have a time series of all these statements of cash flows, and based on what we pay for something, right? We can come up with a net present value using time value of money concepts, right? So we talked about how do you inflate values up and how do you deflate values back. We did it manually, we did it longhand, we did the calculations, but then we figured out how we could use Excel tools to do that. And ultimately, we got rid of all these and we just said, you know, in real estate, we kind of take a look at IRR, and we take a look at some sort of multiple, okay, and we look at cap rate. Now, these are very simplistic, it's a bunch of other ratios, but we kind of got rid of, as we continue to build models, we kind of got rid of the manual calculations, and we just started relying on Excel tools to figure out our project return, right? Some sort of simple multiple on what, you know, what kind of return we're getting, how many times are we getting our money back, okay? And looking at relative valuation in the marketplace, okay? That's all we've done. That's all we've done the whole term, right? So, but as we went on in the series, we started adding intricacies, right? So at a certain point, you know, early on, we stopped at NOI. Then we introduced the concept of debt at some point. Then we introduced the concept of capital expenditures at another point. And then we started putting bells and whistles on these things. So we started with simple amortization tables, but then we showed some Excel tools where you could do a very simple debt summary that flows into here, right? We started adding at the bottom some measures, right? In addition to the returns. So the cash on cash returns, you know, rents per square foot, annual growth in NOI, in free cash flow, etc., right? That help us understand what's happening with the numbers. Okay? So, I mean, up to now, I mean, I think, you know, we started with a very simple concept, and we've kind of been expanding it and building and building and building and building and building. Okay? I want to start with multifamily. We talked about those. We talked about mortgages. We talked about a bunch of different concepts, you know, these multiples. We talked about weighted average cost of capital because that was important. Cole, I'll come to you in a second. But that was important to understand discount rates. So at what rate do we discount these cash flows and how that relates to the theoretical purchase price that we should pay for an asset. So, you know, we kind of, you know, I think we built this nice model and then we added a bunch of bells and whistles to it. But the whole time we were doing this in a multifamily space, right? And there it's very simple. Number of units, number of square feet, rent per square foot, right? And so that was very easy. And we could take that number and inflate it. Multiply it times what? 1 plus whatever the inflation rate is, right? Pretty simple. That's all we've done. Yes, Cole?
So the IRR is the return for the project when NPV is 0.
That's correct.
What does it mean to have an NPV of like 1? Like, I don't know what that means.
Okay. So the concept in capital budgeting is that any time a project has a net present value that's greater than 0, it's a go. Meaning you have now met all of your return expectations. You've serviced your debt, you've serviced your preferred debt, and you essentially rewarded your equity. Okay? I'll come there and say, you got a question? Yeah, I'll come. and you returned your equity. So that's why we take those three components to figure out WACC. And we use WACC as a discount rate, so that we can work ourselves back to that baseline, right? So at 0, using that WACC, which fully compensates equity and fully pays off debt and preferred stock, right? Anytime you have more than $1 more than that, it's a go. Yes or no? It means you've satisfied your return expectations, right? Your theoretical cost of equity is what your shareholders expect to be compensated. Either, we talked about concepts of holding period return, either through distributions or through capital appreciation. That capital appreciation in a public company perspective is your share price, but in a private company we can talk about things like net asset value, or we can talk about sales prices whenever we monetize something. Judson?
It was similar to Cole's question on the IRR. I understand how to calculate IRR and the concept of it, but like sometimes I just have trouble of truly understanding what IRR exactly represents. Is it after? I know net present value would be 0 for IRR, but conceptually, without the numbers, is it the percentage that you're gaining? I'm just confused there.
So IRR is essentially the discount rate that you would use in order to get to an NPV of 0.
Discount. Okay.
So does that make sense?
Yeah, I mean, I know the mathematics side of it, but
Well, but just think logically. At zero, your IRR equals WACC.
So it's the same thing, WACC and IRR?
At 0.
At 0. So you need to understand net present value in order to get to internal rate of return. Okay? So you start with net present value. Net present value, right, is the point at which, in today's dollars, the returns you're getting in the future exceed your outlay today. I pay 100 for something, right? So it's a good place to go to the next sort of concept, right? I pay X for something. Now we talked about just discounting single values back a certain amount of time, but we really spent more time talking about annuities, which is, you know, an annuity is you're an old person, you go to a life insurance company and you say, here's 100, I need $10 every month. Okay? So an annuity is I pay X in exchange for a series of payments, a stream of payments. Okay? And that's all real estate is, right? In fact, for me, I understand we all think differently. For me, it's much easier to understand a retail, you know, or an office lease, or an industrial lease than it is to understand multifamily. Why? Because a lease says, you're going to pay me X every month for the next 60 days. It's like an annuity. It's like an annuity. So when you buy real estate, you're buying an income stream. You're buying an annuity. It's not called an annuity. A life insurance company doesn't sell it to you, right? You're buying an asset that produces an income stream, that free cash flow, which is just like an annuity. So what you could do is take that income stream, and I want to get to your question, and discount it back to figure out whether it's worth paying for it, what's being asked or what you're proposing. And so the question becomes, I'm thinking I'm going to pay 100, right? And so discounted at the IRR, okay, discounted, you know, Excel can give you what the IRR is on this income stream, right? Discounted at that rate, right? The question is that IRR greater to or equal to my net present value, okay? Because if my IRR is greater, right? I'm sorry, and your WACC. Because if my IRR is greater, I'm going to have a positive net present value.
Oh, I get it.
So, the easiest way to take any one of the models that you have, say it yields 15%. right? Say it yields 15%. Use 15% as your discount rate and solve for net present value. And you're going to see that it's going to give you 0. And so what that's telling you is IRR is that rate, that discount rate, at which comparing this income stream, using the time value of money concept, bringing it back to today, the stream equals what I'm paying for the annuity up front. I'm paying $10 million for this asset. It's producing $1 million a year for 10 years. I'm going to discount that at my IRR. If it comes back and it equals the 10 million, I should buy it. Because I've not paid my debt, I've paid my preferred stock, and I've paid my equity. Alec and then Jonathan.
On the same topic of buying an asset, looking at the hospitality model, so you're evaluating whether you're going to buy a hotel or not. When can you use that for a development?
We're going to get to developments later today. Hold on to it. We'll get to it today and next week, so hold on to that question. It's no different. It's just an extension of what we've been doing.
Yeah, but are you using that purchase price in terms as your development budget in a way?
I'm not using a purchase price. I've got development costs to take place of. So instead of buying something, I'm going to invest in building something. But absolutely, that's what I'm going to, that's my outlay.
Right,
So my initial outlay is I can pay $10 million for a building that has some income stream, or I can pay $10 million to construction companies, architects, engineers, municipalities, etc.
That was my question.
Of course, it's the same methodology.
If you could back into your total development
Well, you don't back into it. That you got to build that from the bottom up. It's different, right? It's different because the market's going to tell you what the costs are. I mean, listen, the market's going to tell you what the price is. Right? So the question really becomes, can you live with the return profile that it gives you? Right? Is your cost of capital commensurate with where the market is? And the market may be whack, like literally whack with an eighth, not with a, they may be totally out of sync. And then you have to have enough discipline to say, you know what, it's not the time to buy. It's not the time to build. It's time to sell or to sit, sit tight.
Can I just verify, did we say bonds were like annuities in reverse? Like in which case we were making a stream of outlays to get a premium in the future?
First of all, you need to understand which side of the bond you're on, okay?
Yeah.
So are you the issuer or are you the buyer?
You're the buyer.
Okay?
Okay.
Well, if you're the buyer, what you're getting, you're buying essentially like an interest-only mortgage with a balloon payment at the end.
Right. Okay.
That's all you're getting. It's an interest-only mortgage. Now, it may not be secured by real estate. It may not have a mortgage, right? You could just be buying a general obligation bond, right? And so what you're getting is an interest-only stream of payments. There's no amortization of the principal. You get a balloon payment at the end.
Okay. And if you're the issuer?
It's like going to the bank and getting an interest-only mortgage.
Oh,
Somebody's giving you money and you're going to pay interest, and at a certain maturity date, you're going to pay off the principal.
Okay. Okay, that makes sense. Okay.
That's all it is.
Right. Okay.
So sometimes we I got to figure out the formula, and we lose sight a little bit of where, what these things are, right? Mm-hmm. So I mean, we've done. So we also added a bunch of sensitivity analysis tools down below, right? And those take up a tremendous amount of time. Data tables, right? So I did something. I was working on something yesterday for I have a board meeting this week coming up, and I had to do something. I did VLOOKUP. Hadn't done it before. I used geomean because I was working with percentages, and I had to solve for something. And so I used solver. What's funny is I tried to use GoalSeek. It had nothing to do with any of these intricate models. A very simple thing I downloaded from Fred. You can go in there and get data that you want or need. It was cost of living. CPI since 1947. Okay? and GoalSeek wouldn't give you the answer, so like Solver got it like this, so GoalSeek is just like, you know, it's kind of whack, I don't know, that's why I just use Solver all the time, but, so, I mean, the one thing here is with these data tables, we can spend a tremendous amount of time doing, you know, building them. We've realized that if we don't have that flow perfect down here, right, and everything is connected sequentially, then they don't work, right? And even then, sometimes, they don't work. That's the way it is, you know? So sometimes you can do sensitivity by, you know, like, you know, we've got that holding period table that we did. Sometimes you can't use a table because it doesn't work. Well, you know what? But if you build in those conditional statements in your measures of performance, you could just adjust the years and figure out what the IRR is if you sell this year or you sell that year. So, you know, you can kind of do it iteratively without having to, you know, build a data table. Yes, Cole?
Since everyone's cost of money is different, wouldn't that like kind of ruin the standard for IRR, since everyone is measuring based on like how expensive their capital is?
So I started, I don't know if I started this class, but I know I've mentioned on multiple occasions that real estate is a financial asset. Mm-hmm. And if you go back to John Paul Burr, or whatever his name was back in the 30s, who wrote about financial instruments, you know, it's sort of like, you know, modernization of securities markets and things like that. He said a financial asset was worth nothing more, nothing less than the net present value of its income stream, of its cash flows, right? And remember, cash flows come in if we think about holding period return, cash flows come from current income and they come from appreciation, okay? Mm-hmm. So you can't just reduce cash flows to, you know, what's my current distribution or what's my current yield, right? There might be some capital appreciation. But if we kind of take that out a little bit further and say, you know, you should only pay, you know, at that point where the net present value is greater than zero. Now, if you take that a little bit further, you say a financial asset will only clear the market, will only transact specifically at that equilibrium point, because no willing seller is going to give up their asset for less, and no willing buyer should pay more. Now, your question is, yeah, but if everybody's got a different, you know, cost of capital, that point at equilibrium is not going to be the same for everybody. And technically, you're right, but pragmatically, they're relatively close enough. And I think that the point, the anecdotal point that I go to is, I was talking to an attorney who we used to do work with, and he's involved with my old boss, and he's involved in some of the deals I'm involved in. And we developed a 240 unit apartment complex out in Naples. And originally we were going to hold it, but cap rates are so crazy, we're just selling it, you know. So I called him up and I said, look, you know, is the deal, do we have a deal? Yes, we have a deal. When does it close? It closes in January. You guys got the buyer. You know, my concern now is it going to close, right? I mean, I want the money. I can, you know, when you start smelling the money, you want it, right? And he said to me, George, he said, we had like 80 people look at it, okay? And he said we had like 18 offers. And this goes back to everything I've talked about. He said, we had 4 offers that were right on top of each other. So you know what? If these guys can't close, we'll just call one of the other 3 and they'll pay for it, okay? What happened, I didn't read all the details, but somebody, Apollo's buying Tech Data, which is a big computer distributor out of Clearwater. So this came out last week. They're buying them for like $4 billion, and then Warren Buffett like flew down on Tuesday or something and said, look, I'll give you X more. And he thought he had a deal, and then the next guy came in and gave a little bit more. But they're all sort of infinitesimal sort of points, right? And so that apartment building in Naples, you know, confirms to me that, yeah, everybody's got a, you know, technically a different cost of capital. They're practically all the same. They're close enough to one another, right? At least by industry, right? Most REITs, most private equity groups in real estate are going to have a very similar WACC, and that may be a totally different WACC than a tech company that has a lot more risk. and relies a lot more on capital appreciation than current income, right? So the expectation from the owner, right? Time brings uncertainty, right? Brings more risk, more reward. So if you're investing in, you know, cancer research pharmaceutical firm, your return expectation for that is going to be significantly greater than if you're buying stock in Florida Power and Light or in Prologis, which is just a stale business of renting 98% of the industrial warehouses to credit tenants under long-term leases that don't have this huge growth, right? They don't have the big pop. The pharma does, right? And they discover a cure, boom, that thing's going to go through the roof. You're not going to get that kind of capital appreciation in a REIT or in a utility. And so the return expectation on the equity is going to be significantly different, okay?
For a developer like Florida Crystals, that their main source of income is, you know, the sugar business, but then they also have a development arm. How do they segment that? Is that under a different?
Yeah, so Florida Crystals is not a development business. Juan Borro runs that in, and I've known Juan for a lot of years. I coach his kid. He has his boat next to mine, but I really don't get into his business. But for, you know, going back 20 years, the Fanjuls who own Florida Crystals have wanted to do two things: is monetize some of the land that they have in the Okeechobee County area, and they just generally wanted to get into real estate. And they had another guy, Arthur something or other, before Juan came to work there. But those are all personal investments that have nothing to do directly with the sugar business. And in fact, a lot of what they're doing isn't even on Florida Crystal's land. They're just really they're merchant developers. But that's just something that the Fanjuls wanted to do. And I don't know the intricacies of their business.
It's kind of like a weird mix.
Listen, as with any, I've said it before, that almost, I saw one of my former players yesterday at the store, and he went to Boston College and he works for a real estate development business in Boston now. So, I forget the name of the business, but they own, it's like a family that owns a bunch of strip centers, and it's expanding to other asset classes, but, you know, like a lot of integrated development businesses, they've got a development company, they've got a construction company, they've got a leasing and management company, okay?
Brokerage.
Leasing and management, okay?
What's your opinion on the management?
Let me finish. But I can assure you that the ownership of all the assets that they manage is sitting out here somewhere, and it's owned directly by the people that own the development business. The development company doesn't own the assets, okay? My opinion on management companies is that they're complaint departments. I don't want to be involved in property management. They're not profitable businesses, but what they do give you is a tremendous amount of market reach. They give you, guys, pay attention here, man. It's very distracting. It gives you access to the market. It gives you access to clients, to tenants, and to activity and transactions that are happening. So, if you're a good development business, you need to have a property management operation. And you need to be very close. If you don't have a brokerage operation, you need to be very close to the brokers that you're using for your asset class, and they need to give you the same sort of level of support that they give only their top customers. Okay, because they can direct things in the leasing world. They can direct things. Okay. I want to. I'll probably the computer in a second, but So, you know, we move forward and so we got as far as building our annuity, right? And we said real estate was an annuity. It's kind of like the present value of an annuity. You pay a certain amount for an asset in exchange for some distribution, some free cash flow that's going to come to you over a period of time. And that cash flow, the way we model, is always going to include a reversion. Okay, okay, we talked about perpetuities, we ultimately had to have some sort of terminal value. You know, the reality is if you run a model for 20 years, what's happening is 20 years from now, the present value of those cash flows becomes very, very small. So we sort of need to assume that there's a reversion somewhere down the line. And because most private real estate equity funds have a 10-year life, which is 10 years. It just seems to be, 10 years tends to also be a nice maturity for securitizing life insurance company debt. So it's just kind of a nice, midterm horizon. Okay. So we did this. We got the multifamily. Okay. And the multifamily income statement was very simple, right? There was rental income, right? We had some losses, right? We gotta call them vacancy and credit losses, but there was some losses, right? And so we got to some, effective gross income number. You can call it whatever you want to call it, okay? But we got to some sort of revenue number, okay? And then the concept of reimbursable expenses doesn't exist there. Residential leases are by default gross leases. A tenant pays an amount, the landlord pays the expenses beyond that. So by default, without calling them gross leases, multifamily leases are gross leases. You pay one amount, and that's it. You don't reimburse the landlord for anything, right? Now, you may have, we, in one of the models, added some other income, right? When we really did the full model, yeah, you may have laundry machines in there. There may be fees for clubs or for parking or for pets or whatever, okay? But there's no reimbursement for expenses. So when you pay, blanketly, I'm not going to tell you that there isn't, because I know somebody who lives in a place where they got to pay a premium for, cable or whatever. They got to pay so much for electricity. But in general, once you get beyond the ancillary services from revenues, the tenant doesn't give you anything else. And so from there, you can come on ahead and do your operating expenses, right? And what did we say those were a percentage roughly, ballpark? Do you remember what those were?
38, 35.
Broadly between 35 and 45, probably somewhere closer to 40. I think we used 38.5 was what I came up with, like as a national average from, Baltimore or one of these places, but somewhere there, right? And so this is relatively simple, right? Do we have any questions on building a multifamily model? Any questions? No questions. Okay. So then we went to hospitality. And hospitality is a little bit more complicated, right? Because it's an operating business embedded inside a real estate business, right? And in fact, I explained there's a lot of different variants in the hospitality industry. There are scenarios where an owner owns a building and does a master lease with an operator. And the operator operates it as a Hyatt or a Marriott or whatever, and all you do is get a rent. And everything directly related to the operations of the hotel have nothing to do with your income statement. You're getting a rent payment. But it can go from that extreme to you own a real estate and you operate the business. And then there's everything in between where you may own a building and operate the business, but you may pay somebody a fee for operating a business, or you may pay them a fee for managing the asset, or you may pay them a fee for the reservation system and for the right to use their flag, okay? So it's not simple, but we went to a model, and the revenue stream is a little bit different there, because there we talked about the concept of total available room nights, right? Which we said was, number of rooms, right, multiplied by the number of days. I'm going to assume 365. Let's assume most hotels operate year-round, but that's not the case everywhere in the world, right? Some places hotels don't operate year-round, okay? And so that's going to give you total available room nights. And then we introduced the concept of occupancy, okay? Some percent, right? And so we said of all the available room nights, really only a certain amount were rented, right? So there is there's a vacancy factor in hotels that we said was very high. And I forget the number, but it's somewhere around nationally, something like 60%, and in South Florida, it's something like 70% occupancy, okay? All right? So we talked about two major concepts that affect revenue. In the hotel industry, they use ADR and they use RevPAR, okay? Which is average daily room rate and revenue per available room night, okay? But what we did is we calculated, right, we calculated a lot of different ways to do it, but we could take, you know, the actual effective nights, right? We could multiply that times the average daily rate, and that gave us room revenue. So that room revenue is kind of like our rent, right? People are looking like I'm not getting good vibes. I'm not getting good. I mean, we'll repeat it again. I'll repeat it again. Does it make sense?
I think we're just getting very
Tough for the visualize.
but it's good information nonetheless.
Multi-family is easier to visualize.
So this room revenue, this calculation here, is equivalent to our multifamily rent. Now, just like in multifamily, so we could put room revenue, right? Now, in multifamily, we had other income, right, for laundry and pets and all that stuff. We got the same thing in hotels. We got food, we got beverage, right? We got telephone, we got other services.
What do you mean by telephone?
Okay, dude, like in the old days, let me explain something to you.
They don't do that
In the
anymore.
old days, back in the old days, 10 years ago, people used to use this to talk. It wasn't to send text or to check, you know, let Google give you the answers to everything. People would talk. Before these existed, dude, talk to me about telexes, okay? Don't talk to me about. Before those existed, you walk into a hotel room, and when you got to your room, you made calls. So you're a salesman. You're in New York. You got to schedule your appointments for the next day. You get to your room, you sit on your phone, right? And you start dialing for dollars. You start calling and make appointments. Your wife wants to know if you got there safely. How does she know?
You send your spokesman. No, you check Instagram.
That's not
Carrier pigeon. You check Instagram.
You check the pictures that you posted on Instagram to see if you're cheating on her or not.
No, I saw an article.
So you got to go to the real.
She doesn't have that
not to
Instagram.
the.
No, but on that same topic, I saw an article for Chicago that some hotels are not putting restaurants in there anymore because of Uber Eats. So
Yeah, I heard that. I heard that from a developer last week too. Yeah, possibly. I mean, listen. Hotels, just like any business, need to evolve. Businesses need to evolve. And so, if part of the evolution of a hotel is that they don't provide food, great. Now, the problem is beverage is a big profit. So food doesn't make a lot of money in hotels, but beverage does. Okay? And some hotels that are destination hotels make a tremendous amount of money on food because they host weddings and other events. And that's where their money comes in, because they're using that to drive a bunch of room revenue too. But we calculate room revenue, and then we've got a bunch of other income, ancillary income. So now we've got a revenue number. But that revenue has a cost, right? So in a multifamily context, there's no cost for the apartment. But if you're selling food, there's a cost for the food and the guy that prepares it. If you're selling drinks, there's a cost for the bottle and the guy who serves it. If you're selling a room, there's a cost associated with it. Somebody's got to do the linens. Somebody's got to clean the room, right? There's supplies that go in there, the soap and all that other stuff. So there's a cost associated with renting a room, right? And so there's, going back to the context of, or the concept of gross margin, revenues less cost of revenues or cost of sales give us gross margin. And that's all a hotel income statement is. For each one of these revenue items, there's a cost of goods sold item. There's a room cost, there's a food cost, there's a beverage cost, and there's a cost to other items. And now that gives me gross margin. Now what can I do with that? Now I got a building that has operating expenses. What are the operating expenses in a building?
It counts those things too.
Electricity,
Capital expenditures or not?
electricity,
It could be utilities,
insurance.
real estate tax, they're not any different in any real estate class. Real estate taxes,
insurance.
utilities, insurance, repairs and maintenance, maybe security, depending on the type of hotel, etc. Right? So now, from here, now we can deduct our operating expenses. Now, we could say we got the NOI, there's an additional nuance in hotels. What's the additional nuance in hotels? Does anybody remember?
Yeah, it's the,
Management fee, right?
no.
There's a management or a franchise fee, and they also don't consider operating, real estate taxes part of operating expenses. So they've got something which they call operating income, okay? And then they subtract real estate taxes and any flag fees, okay? Any operator fees, okay? And that gets them to NOI.
Then,
It's comp room, I think, complimentary room.
A complimentary room is like a lease abatement.
Where would you?
Somebody's occupying a room and they're not paying for
you
it.
just wouldn't,
Where
you
do
wouldn't
you
even
allocate?
have.
It's like a rent, it's like you rent an apartment for 12 months and you get a month free.
You just wouldn't include that in
It's a
the-
loss of revenue.
in the RevPAR.
Well, let me jump to industrial and office and retail for a second and show you how I use general vacancy. Because what you can do is two things. You can charge the room at the full rate and then provide an allowance against it, or just not recognize it at all. As accountants, we like to report things gross. So ideally, a complimentary night, you would reflect as revenue, and you would have some sort, in cost, there'd be some general ledger account that would have free rooms or complimentary rooms.
Yeah, because also with all the things that come with the room, like the food and the additional expenses, that might not be included in the comp room either, because that would still
Hopefully,
contribute.
complimentary rooms are not a significant component of your business, because if they are, you're not gonna be in business.
Yeah, but
Well, but if you're next to a casino, you give comp rooms all day.
Most casinos give out free rooms anyways.
Right. So then they're making the money on
You
the
guys
other
must be
side.
high rollers, I've always had to pay,
It's only comp to the guests.
Well, that's
not
coming,
to the
right?
hotel.
With the racetrack laws,
So for a hotel, if you're doing a master lease, would it be similar to like single tenant returns, or would it be higher?
triple net.
I mean, that's a credit question, right? So, if you're doing a single tenant retail lease for like a Walgreens or CVS, you're underwriting their credit. If you're doing a master lease with Hyatt or Marriott, you're going against their credit. So, I don't have a specific answer for what the return profile is on those today, but I would tell you, it would probably have a higher return, right? Because I think there'd be an expectation that the operator carries more risk than these pharmaceutical distributors. Okay? I don't have a specific answer though. Okay. So, that's hotels, and then from NOI, what do we subtract? What do you subtract from NOI? CapEx and? Debt service, okay, so, now, so that's what we did last week. So this week I sent 3 videos out, and it really went through the other 3 major asset classes, which are huge. And like I say, for me, they're simpler to understand, but, maybe somewhere along the way, and I took the time in one of the videos to try to go through lease structures, because if we don't understand lease structures, then we don't understand how income works, right? And so, I differentiated between a gross lease, and we talked about this in class as well, and a net lease. So what's the difference between a gross lease and a net lease? What's the difference between a gross lease?
The tenant-
Isabel, you know the difference?
The
Kind of
gross
big
is
part.
without the expenses,
What do you mean without the expenses?
Like, every, all the revenue before the expense, like the real estate taxes, everything, and then the net is the money you get after.
Well, I kind of get lost in your explanation there. I'd get a little bit lost. So let's look at an income statement for a second. Let's look at a statement of cash flows, okay? So let's say that an industrial building has operating expenses of $3. A building has operating expenses of $3, okay? I'm a landlord. I paid $100 for the building, and I expect a 10% return on my investment. Okay? What does he have to generate in lease?
$13? No.
What does he have to generate in a lease? How much income does he need to get?
113.
Net, he needs a net 10 to get.
He needs a net 10. He needs 10. He needs 10 here. Okay? He needs 10 here
He needs a net 10.
to meet his return hurdle, right?
Right.
Okay? And somewhere here, so this is his NOI, right? He's got expenses, OPEX here. Okay? We know they're 3, right? What do we charge the tenants under each lease now?
$13.
Well, so we can get to the same number in 2 different ways. We can charge the tenant $13,
Or you could pay the 3
or get to our net, right? Or you can do a net lease where you bill a tenant 10 and he reimburses you the 3. You pay them, but he has to reimburse them to you. Because if he doesn't reimburse them to you, how do you know if they're getting paid? Right? I'm the landlord. I'm the one who's got the account with Florida Power and Light and you know, whatever water, you know, whatever. And I'm the one who contracts security, and I'm the one who contracts the cleaning services, and I'm the one who pays the insurance. So I'm going to pay the expenses. I'm just going to have the tenant reimburse me as a landlord. So conceptually, these 2 structures are the same. The one nuance is we charge a tenant a gross number here, and here we charge him the net and ask him to reimburse the operating expenses.
When would he reimburse the operating expenses?
I send you a bill. I send you a bill for lease, and that invoice I send you has a lease payment on it and a reimbursement of operating expenses on it.
Oh, okay. You just split it up in the bill, that's the only difference.
Yeah. I mean, I can send you 2 bills. I mean, you know, it depends on
Sure.
you know, everybody's struggling. You know, you get reimbursed quarterly or adjust quarterly or once a year, you know, or catch up. But we're still theoretically going to the same realm. Now the question becomes, who has the risk under either structure? Who's at risk here if operating expenses go up?
The landlord.
The landlord. Who's at risk here if the operating expenses go up?
The tenant.
The tenant, okay? So, because we think as landlords, because we're real estate developers and owners, there are a couple of ways to mitigate your risk here.
But it's only for industrial or office.
And how do we, office, industrial, and retail all have these components in it, guys.
I'm going
So,
net. I'm going net.
so, if we have operating expenses of 3, how do we mitigate as landlord these expenses?
You gotta give it higher gross, you gotta put a higher rent.
You do a base
We could do like a base year or a base stop, right?
base stop,
Base year
base year.
or a base stop, okay? And in those scenarios, you say, okay, if you sign the lease, I don't know, just to say something, in 2010, you'll use a base year 2010. So any increases in 2011, 2012, 2013, at the end of the year, the landlord will figure out what the operating expenses were. They went up to $3.10. Well, he's going to bill the tenant the $13 plus that increase over his base year. Or you might say the base stop is $3. Okay? So you say any increase over that base stop is going to get pushed to the tenant. So in a gross lease, you're going to get the gross payment plus some sort of adjustment for the base year or the base stop.
But wouldn't you say net is still more simple then?
Well,
It's still.
I mean, as a landlord it is, right? But the question is, what does the market, you know, call for? And I could tell you Dade County is an industrial gross market. Broward's a triple net industrial market. Why? They're right next to each other. I don't know. That's just the way they are, right? Office leases tend to be quoted more as what's called full service, which is a gross concept, than net. Why? It's common practice.
But with the base structure, you're still paying, the tenant still pays the same amount, would still pay all of the
Well,
expenses.
hopefully you've got it set up. Now, I mean, you're assuming that the tenant's going to accept, you know, that year and that base stop number. The tenant, you know, that's a negotiation factor. You know, the tenant might say, no, dude, I'm paying you $13. I mean, I'm not going to pay for your inefficiency. So you might negotiate a base stop that's actually $3.25. And as a landlord, you're eating the next 25 cents of increases.
So anytime it goes above that 325,
Yeah.
then it's your.
Or you might say, listen, I got bumps built into this lease. I got 3% increases in this lease. Part of that 3% increase is going down here. So don't give me a base year increase until like 5 years from now. So, I mean, you're assuming that that concept is going to equate to the day you sign the lease. Not necessarily. It's a negotiation point. Okay? So, now, does this make it a little bit easier? Do we
Yes.
understand this?
Yes.
Now, let me explain one other thing, and then I'm going to do the P&L, okay? In the context of office and industrial, this is what happens, okay? I explained that in office, there's something called full service instead of gross. So, you know, industrial gross or triple net in the industrial world, net in office. But the equivalent of gross in office is called full service, okay? And there are a couple of general exceptions to that. Sometimes tenants separately meter, so you would say full service, net of electric. Okay, so that's a hybrid where you're in a gross lease except for electric, where the tenant is paying directly. Okay, or net of electric and or janitorial, right? Where again, you're gross as it relates to everything except electric and janitorial, which the tenant will pay directly. Okay, that's very common in office structures. Okay, retail has one other nuance. Okay, and the nuance that retail has is that they have what are called percentage rents clauses built into their leases. So a landlord is not only going to charge you a base lease, a landlord is going to charge you a percentage of your revenues on top of that. Now, how much is that? Well, it's all negotiable. You know, how badly do you want to be in a particular center? How much pricing power does a center have, right? I think the last time that I looked, and Simon is a unique company in that they've got high-end centers, but I seem to recall their percentage rents were only something like 7 or 8% of their total revenue. So it's not a significant percentage of their overall income, but it is in fact a sizable amount of dollars. Okay? And so typically, in addition to the rent, the landlord is going, the tenant is going to pay a certain percentage of their net sales. Okay? And so you'll see in most centers, there's some sort of linkage between the cash registers at the store and central management, because the operator, the management company, needs to know what you're billing.
I'm
Yes.
assuming that's more in retail than it would be out.
It's all retail.
Only retail.
It's only retail. Okay, it's only retail. Okay, so what does an income statement look like? Well, so we're going to have our gross rents, right? Okay. And from there, one of the concepts that I talked about was structural or vacancy loss, right? We could have credit losses here. Hopefully we don't in these asset classes, okay? We could have credit losses, okay? And so we've got a potential gross income number here, right? If we've got retail, we've got percentage rents here as well, okay? Because percentage rents are going to be part of my potential gross income. Now, from this, we've got to have expense reimbursements. And then we have operating expenses. All right? If we're in a gross lease environment, if we are in a gross lease environment, there are no expense reimbursements. So we subtract gross income, or we subtract operating expenses from gross income, right, to get down to NOI. If we're in a net lease environment, in addition to the gross income from the lease stream, what else do we add? The reimbursement of operating expenses, and then we subtract operating expenses from that to get to NOI. What's the impact of this? The impact of this is that if you're fully leased and your gross leases are fully covering your operating expenses, is that should be 0, right? And if you're in a net environment and you're fully leased, the impact of doing this is what? That your operating expenses are also 0. There wasn't anything else to these asset classes, guys.
Could you explain real quick just the from the videos, kind of the way you're doing it now is the how you calculate? I guess the occupancy you were just taking down, but as far as conceptually on that, because you were taking all of them.
Yeah. So I mean, it's no different. What we did in multifamily. So multifamily, we essentially came up with gross revenues, right? We basically said total number of rooms, right? Or total number of apartments, right? For each one of the unit types. We said total number of units, total apartments, times square footage, right? Times rent per square foot, right? And we put that there. And then what did we do? We subtracted a vacancy factor. Right? We also subtracted credit losses. So we could do that in industrial, retail, or office, or as I built out, we've got an income stream that may only have us at 85% leased, and that's what goes to the gross revenue number. Now, you can present. You can take your stated rent, you can say at 100%, my gross potential revenue is X, and subtract the vacancy factor from it.
Which is what we...
You can do that, and really, what I tell you, what I've seen is typically you only see in revenues what you're actually renting, but when you're building models in Excel, you've got that whole gross vacancy number. I'll show you the gross vacancy number down there, which is what you could use to, so you don't have to build all that whole revenue stream on the right side of the spreadsheet. You could just play with the general vacancy to get to the number that you want.
Yeah.
I'll show you. I'll pop this up now.
So instead of building out that entire thing that we did, you can just play around and adjust. Hey, I know
what my base rent is. I know how many square footage I have, and I know what my vacancy is. I can build, and I know what my operating expenses are. I can build a statement of cash flows.
You can just multiply it by 85.
Pretty straightforward. So
Just do it.
let's
Just clean them up. Huh? Just give
What am I trying to do?
What are you going to do?
I'm gonna show you the models on, do you guys see my, what do you guys think of my sunset?
Saw that in the video.
Looks rich.
I'm sorry?
When I was rotating, I'm like,
Yeah.
What, I'm a nature dude.
So,
I just don't have trees.
I haven't heard that word in a while. Could you put us? Could you go over how you build the metrics tab?
yeah, I'll do that. Okay, so, this is the down and dirty, model in Office. So, just a couple of things to point out here. Let me make this just a little bit bigger, but not a lot bigger,
You
because
can see, can you email them to us?
sorry?
Oh, that was perfect.
So, potential gross income, base rental, less absorption and turnover vacancy, right? So this is my income stream. I'm in a triple net lease. So the way I built the models were, I built office and industrial as triple net, and I built retail as gross. Okay, so in the triple net environments, you've got the reimbursement of the expenses. Okay? In a gross environment, this doesn't exist, because you have rents and you just subtract the operating expenses from it. Okay? Now, potential gross income, so we get to our base rental revenue, we've got our expense reimbursements. This is the line that you can play with, okay? So that you don't have to build the whole income, the whole sort of lease structure out there, okay? You get to effective gross rent, you subtract your net operating expenses from it, and
Not everybody's meaning.
now, this all starts here. Okay, so what did I do? Everybody seemed to get really lost here.
Yeah.
I wonder why.
What the hell is that?
I spent the entire video.
I spent a whole
This is real
night
estate,
there.
man, this is real estate.
That was the easy part.
I didn't say anything about it. What do you mean I didn't say anything about it? I started here.
No, you should have started from scratch, Professor. You had it already.
You want
built.
8-hour videos,
At least this. At least that.
I said that last week.
I agree, that was easy. My thing was the
You need
absorption
8
and
hours.
the
I
abatement.
mean, this,
I didn't get that.
so, sorry?
I got that. That part was easy. The
It was
absorption
not
and
easy.
the abatement was the
Not
part that I couldn't
Okay,
back
so-
up.
Easy.
So
want
listen.
to be that guy.
So
No, I'm not
let's,
being an ass. Like, that was easy.
guys, let's not focus on what we didn't get. Let's get it. Let's get it, because all this is, and the intent to do this here was to mechanically show you how one would compose an income stream. If somebody gives you leases and says, build a model from these leases,
Yeah, I can.
you know, I've got an office building with 5 floors. I said this all, you got an office building with 5 floors. You've got 4 suites per floor. Each suite is 6,500 square feet, okay? And then I color-coded by tenant which spaces were occupied. Now, listen, you could do this manually. You can calculate the monthly rent and then just copy it. You could use a bunch of conditional statements. You could get lookup tables. You can go crazy doing all of this stuff, right? But Excel, it's limiting here. I said this last week. That's why we use Argus, which is a database, to model these at a very intricate or granular level. Okay? But, to essentially get your rent roll, right, there is information that one needs to calculate in order to do quick and dirty models. Somebody needs to, you need to lay out your tenant roll so that you can calculate what your in-place lease is, right? Because if you know what your in-place lease is, it's no different than multifamily. I can grow it 3% every year. I can grow it 2.5% every year. It's that simple. But all I need to do is get my rent roll and get my average rent. And if you look at if you look at, I'm sorry, my in-place rent. If you look at, it's just an average of all of the different spaces. Okay. So this section in particular, what did this is because there are renewals in this time frame, and that's where it becomes very intricate, right? You need to figure out what the then market rent is. So all this is starting with today's market rent and inflating it. So when we get to a particular year, we can redo the lease there. I put a series of assumptions here. When a lease expires, the space is dark for 6 months. I need to spend $35 a square foot on allowance, right? I got to calculate a lease, okay? And then that lease is going to go on for 60 months, okay? I'm going to have no abatements, you know, and so on. So the other day, I brought these sheets and left them up here. These were the input sheets I used to use for Argus. And I explained the importance of understanding the income streams in real estate. So in multifamily, it's easy. It's a bunch of units by a square foot per unit, right? But in these other asset classes, you got a bunch of other intricacies here. What's the term? What are the increases? What's the lease structure? And then what happens when the lease expires, right? So it's real simple to live in a multifamily world and say, I got 97% occupancy. And if I want to mess with it, I'm going to make it 96.5. But industrial and office and retail don't work that way. They're a little bit more complicated. Okay? And they've got capital expenditures that multifamily doesn't have. I got to pay leasing commissions. And I got to build out space for people. Right? But I mean, that's why we're in this program. So we can look at we could just do multifamily models. But then you get thrown out there and say, well, professor didn't show me that we got a series of other considerations that impact my free cash flow. Because if I don't understand how to get to NOI, but more importantly, if I don't know how to calculate the CapEx that comes, if I don't know how to calculate leasing commissions, if I don't know how to calculate TI, then how do I get to a free cash flow number? So, you know, I left this here. I don't think anybody looked at it. Nobody came up. But these, okay, good, I'm glad. Okay? But, you know, and there's a whole series of assumptions you got to figure out. You know, what are the rents going to be that year? How are expenses going to grow, right? What kind of, the guy renews. What kind of commissions do I pay on a renewal? So, there's a series, there's a lot of input. It's kind of interesting. I've always had...
You pay commissions on renewal?
Sometimes you do. I mean, I'll tell you what, the broker's going to demand it. So the broker out of the box is going to say, that's my tenant, and I brought him to you. Okay? And if I hadn't brought him to you, he wouldn't be renewing. Now, you got to take a look at the brokerage agreement that you signed with the guy. And in all the agreements, the broker's going to try to get representation rights on the renewal, and the landlord's going to try to get rid of them. And any broker worth his salt is going to have a relationship with a tenant where the tenant's going to come to you a year before the lease is out and say, hey, Alec is my broker and he's going to represent me in this renewal. And if you're an intelligent landlord, you over the years develop a relationship with the guy so that he doesn't have to call Alec, he deals with me directly. And some assets are going to lend themselves more to that and others are not. Okay? So all this was is like, oh wow, you went all the way out there or whatever. All I did was, I did a month-to-month schedule of the leases so that I could derive income. Now, the easy way to do this, I know what my in-place rent is, right? How much is my in-place rent? $22 and something I just said?
Yes.
How many square feet do I have? 125,000 square feet. How about in my first year, right? Because look, I can just delete this, okay? All it is, it starts here. It's like multifamily. We start with in-place rents and multiply by the number of square feet. Everything else is just inflated. and vacancy is just a percentage of that. What percentage? Well, the one I want to use. Now, in this particular case, because I actually had taken the time to schedule out the leases, I knew that those downtimes were going to give me structural vacancy of 2.6%. So that's the number that I used. But if you don't have that, grab something out of the air. I mean, I don't know who got to the retail one. I built the retail one. It was less than 5 minutes. It was less than 5 minutes. But all it is knowing this number, making this formula, and copying it across. And because it was a gross lease, I already had the table of the operating expenses. It was building the base year operating expenses and inflating them.
I didn't even finish that.
I don't finish it.
No, I know.
And your expenses, see.
Okay, so
In your leasing commission,
if you just go, I'm gonna just undo it for a second. But if you go here, right, AC 31 and AC 33. If we go to AC 31 and 33, we see that all it is total square footage and the in-place rent. And then if we come over here to the next one, all it is inflating it. And if we go to operating expenses, we've got a table. So, I mean, listen.
This is the down and dirty version.
Yeah. Well, but you don't want. But you don't want. If you got to do a model like this in Excel, unless you got a bunch of days to do that, out on the right, it doesn't work. Now, if you got a single tenant building, yeah, you can do it. If you've got a strip center with 4 suites, you can do it. I called a friend of mine a few weeks ago. So, you know, they've got a bunch of industrial assets. And they're all little like 1,200 square foot bays. I mean, some of these things got like 400 leases in it. I go, do you build that? And he goes, no, all I do is play with the general vacancy. Okay? And to your point, Jose Pablo, that's why I build the metrics page. All I do is, I look for metrics. So this is my base rental rate divided by base rental. Okay? So, I was using 87%, okay? Because I knew that I had average occupancy of 87%. Why did I know that? Because I had calculated all of the leases all the way out, right? So I knew that I had 87%. But you know what? Your boss can say to you, you know what, build me a model, here's the in-place rent, and just assume the first year we're going to have 80% occupancy, the next year we're going to have 85, the next year we're going to have 90, the next year we're going to have 92, and then you can just level out after that. And you can do that relatively easily. But just, I mean, guys, look. So I can come here to my in-place rent and multiply it by my square footage. And if you want, I can delete that, okay? And then I can just inflate that, right? That times 1 plus my inflation, right? Okay, and I can copy it all the way across. Okay, it's already there, but I can copy it all the way across. Okay. All right, you see nothing changed. And operating expenses, we've got a table of operating expenses. We've built them, right? And we know the square footage, right? So, you know, let's go to square footage.
Yeah, all of the operating expenses would you wouldn't add the vacancy to that, would you?
Well, so it depends if you're in a gross or a net lease environment, right? So the problem that you run into, right, is whenever the problem that you run. Guys, you guys want to pay attention here or not?
It's kind of hard to follow along without like a company computers or something. It's like just watching you type kind of.
So what, did you have a question?
No, not particularly, but just trying to follow along with what you're doing because you're changing some formulas.
I didn't change any formulas, all I did was inflate this. That's why I just showed that this is inflated. It's an inflation factor on the first year, and the first year is the square footage times the operating expense for that.
I have a dumb question. What happens to the cash available for distribution?
Well, I mean, if you've got a model, I mean, nothing happens. You build elements at a time, right? You build revenues, you build expenses, right? You should have CapEx, calculatable, right?
Right.
I mean, the reason I wanted you all to have all these different models is
So you have all that positive.
because you've got your debt service schedule. So you may have to change some references, but you've already got something set up that calculates a debt service for you. Now, if you don't have it, you can build it. It's just time. Yeah, Kenny.
Yeah, can you go up to the abatement, and then also the,
Yeah, I didn't use any abatements, Kenny.
I believe you did. Oh, I'm sorry, it's the one above it, I apologize.
Absorption and turnover
Yeah.
vacancy. So you could use absorption and gross vacancy, just like you would use vacancy and credit loss in multifamily.
Taking the difference of them?
You could use it to reduce your revenues.
Okay.
So if you don't want to model out all the leases, you're coming into a building. It's 80% leased. You're coming into a building. It's 80% leased.
But then your revenue already has technically already has, you don't have to add it, because you wouldn't have to multiply it by 80%. If it's only 80% leased. Right?
Pay attention to this and stop me with any questions. You have an empty shell. These are the shells I've shown you guys how to do, right?
Absolutely.
You've got an empty shell, okay? I'm going to give you some facts and I'm going to calculate them. James, if you've got a question, ask me and I'll blow it up, okay? You're going to take a look at a 75,000 square foot retail center, okay? The in-place rents are $18. How do I do my first year's income?
18 times square foot.
Take the square foot of the total building times the in-place rent.
So $18 times 75,000 square feet. $18 times 75,000 square feet. Okay, now, let's get rid of that. Just get rid of that for a second, okay? That's where the model starts. Any questions? Okay. We're going to assume that inflation is 2.5%. Yeah?
Yeah.
Yeah.
So we're going to point to the first year, right?
Yeah.
And then we're going to multiply that by
1 plus.
1 plus 0.025. Yep.
Yeah.
Now, I can just copy it, okay? I copied it before, so it was there, but we just built our revenues
For the whole thing.
for 10 years.
For 10 years.
Gross.
That's it.
Yeah?
Yeah.
Can we do that?
Mhm.
We can do that. Can we do that?
Yeah.
Okay. Now, I'm going to assume that there is no structural vacancy here. I'm going to make it real simple. I'm going to assume that we are in a gross lease environment.
So then we don't need lease expenses.
We don't need reimbursement.
Oh, great.
We've got operating expenses, but we don't have operating expense reimbursement. I'm going to assume that I'm in a gross environment, okay? Now, I'm going to tell you that operating expenses, let's do this quick and dirty. Let's say that operating expenses are $8 a square foot,
Okay,
okay?
yeah.
All right, so let's hide all these,
Perfect.
okay? And we're just going to call these
Is that per
all.
month? Or per year?
Operating expenses, all, okay? And we're going to say that it's $8
Perfect.
times 75,000 square feet. Does anybody have any question on that? $8 times 75,000 square feet
It's not a year, right? Per year.
per year. Okay? Now, we're going to grow those by inflation. What's inflation? 2.5%, right?
2.5.
So we're going to copy the first year, right? And we're going to multiply that by 1.025%.
Or 1.025.
Hold on, I forgot a bracket here. Okay? So next year is 615. I'm going to carry it all the way across. Okay? Yeah?
Yeah.
Yeah.
Now, let's play with a couple of things. Let's assume that it's a retail tenant. And a retail tenant pays 1% on their sales.
Okay.
Okay? So how much is, so they're going to pay one, and let's say that their sales are $300 a square foot.
Okay.
Okay?
Well, wouldn't it,
So let's call this here percentage rents. Okay? So we've got 75,000 square feet
Times 300.
times $300 per square foot times 0.01.
Yeah.
Oh, no bracket at the end. Okay?
What was
Let's inflate that.
Grow it by inflation.
So let's start with the base here, right? And let's multiply it by 1.025.
What was the 300, I'm sorry?
It's
The
the
300.
per square footage,
$3 per square foot of percentage rents. So they're paying 1% of their sales, and the average sales are $300 a square foot.
The average sales. They gotta give you a cut, is that what we're saying?
Yes, that's what the percentage rents are. Okay? All right. Now, let's just leave this for a second. Let's just assume, for argument's sakes, okay?
There's no vacancy.
No. Let's assume that there is 10% vacancy the first year. Okay? Let's just assume there's 10% vacancy. Okay? So what are we going to do? We're going to go minus, right? There's no sales either, right? So we're going to take the revenue number, okay,
Because that has the sales in it.
times 0.1. Okay? And let's grow that. Well, we don't have to grow that because that's growing up here, right? Let's copy that all the way across. Okay? So, let's just get to NOI for a second. Forget all this other stuff. We just built a model for a retail facility. How long did that take?
2 minutes.
Well, a little more than that.
Well, we started at 12:30. It's 2 o'clock.
Yeah. And that's all. So if you've got Excel, now, how can you play with this? Now, I don't know what happened here. In the metrics probably got messed up with all of my erasing, okay? But notice that this is, well, notice there's nothing there, right? So we could just hide this, right? But I can easily look at this metric now and see that, and this is actually percentage rents, right? Okay, so my base rents are 85% of total revenues, my percentage rents are 14% of revenue, okay? But I've got a general vacancy of 10%. Now, your boss wants you to do some sensitivity analysis. What can you do? Let's increase the, let's decrease the vacancy by 1% every year, So what can you do? Then, hold on, you can come over here, right? Okay, and instead of just copying this all the way across, right? So let's say that the vacancy now is 0.09, right? Or 0.9, sorry, 0.9. Wow, all of a sudden my vacancy is 9%. And let's do that every year until we get to 95%. And then we can just stabilize the asset at that point. Well, I can go on ahead and just copy this. So that's,
Not sure I understand it.
okay, I'm going to repeat it. Oh, hold on, I'm sorry, this has to go to 8. This has to go to 7. And this has to go to 6. Okay? So now what I've done is I've got 10% vacancy working its way down to 5%. And then here I just have to do 5, right, the next year. So this is what the metrics come in for. I can make this 0.005, and I can just copy that, sorry, 0.5.
But you wouldn't want to do it manually like this, right? For us.
Well, so you're in Excel. So your boss wants an answer. He wants to know how much he can pay for this building. Cap rates are 5%. What can he pay for it?
Net operating income divided by 5.
Dude, you can pay 40 million bucks. What can I sell it for in year 5? Let's assume cap rates stay the same. Somebody give me a number.
What's, I can't see yours.
Year 11 NOI over 5%.
Well, why don't I just go to the 5th year of the model? Year 1, year 2, year 3, year 4, year 5. I'm going to use year 6 NOI, right? So I can sell it at the end of the 5th year for $47 million. Why was I able to create $7 million worth of value?
Inflation from the revenue.
I lowered vacancy 5%.
So both.
But notice how I'm getting these huge bumps. Yeah, so inflation in and of itself is going to give you an increase in NOI. But remember, operating expenses are also going up. So you're not getting the full benefit of that. Yes, Kenny?
In the videos, you did the down and dirty, and then you did the breakout. But then you got 2 different outcomes. What's the level of accuracy between the 2?
Well, and that's the reason. That's one of the reasons that I did. I mean, I think both were within a couple of percentage points of one another. So
I think in one of in the thorough one, the one that you did the breakout, you were like $100,000 over or higher.
Yep.
And the other one was like a little bit lower.
yeah, but in one of them, I did another one last night, and totally different example, but the sort of down and dirty was like $3 million different, but it was only like a 5% change. So for 5 minutes, as opposed to a day, your boss wants to know what you can pay for this. Now you know. And in fact, you can actually do a very quick IRR here too, right? Right?
Let's do it.
So how would we do an IRR here?
Put the purchase price as a negative in year 0.
Very good. Right? And then, actually, you know what I need to do? Because we're going to do 5 years, right? So what would I do? I would move, I've already got it in the 5th year.
Need it.
So you still
Let's
have
just
all the cash
bring this down, and then let's just add, right?
We can break down one more so you can add the cash flow.
Shouldn't you add,
very good. You're one step ahead of me, Andrew.
There you go.
Boss, you can pay 10 million bucks for it,
0%.
and we're gonna get an 8% IRR.
Because that's the-
Oh, hey, let's tell them we're interested. We wanna do some diligence on this. Okay? Oh, the guy wants 45 million bucks. Okay?
Cash.
Guy wants 45 million bucks.
Big enough. Not before
You're still up above zero.
Well, okay, boss, you're gonna get a 6% IRR, and you're going in cap rate is gonna be,
5. Or we said.
No, it's gonna be less, it's gonna be like 3.
your going in cap rate is gonna be 4.5%. Okay? Yeah?
What's your exit cap? Yeah.
I just use the same exit cap.
Okay.
that we originally did, the 5%. Well, I used 5% is what I should say. I fixed it at 5. I didn't point back to it. But do you see how you very quick and dirty calculate in these asset classes very similar to what you would do in multifamily? Do we have any questions on this at all?
I keep forgetting. What makes it go again? Net present value.
It makes it a go if the IRR is above zero.
No,
If your MPV is above 0,
Net present value.
okay, or your IRR is greater than your discount rate.
That's the one.
Factors out.
They're the same. Those are the same thing. You're saying the same.
Because they're the same thing. I'm saying the same thing. Now,
Very carried away with that.
But that's a.
the other rule of thumb in capital budgeting is, here's the rule of thumb in capital budgeting, okay? If your net present value is greater than 0, it's a go. If you have limited capital, right, you may not be able to do all of your decisions. So then you do IRR. And what project do you pick? You pick the one with the highest IRR, and then you keep working your way down to the lower one until you run out of capital.
Yeah.
Well, it's what it helps you do is prioritize your investment dollars.
That's possible.
That's what data tables include.
Sorry?
That's what data tables include.
Well, data tables can show you that. I would say more importantly, data tables probably aren't, you know, I mean, you can do a data table and figure out how much disposable capital you have, but the reality is you then have to have a matrix with a bunch of different, you know, investment options. That's more of a sort of, you know, analytical view, right? We can spend $50 million in projects this year. We've got 20 projects in front of us that add $200 million that all have positive net present values. Which ones do we do? How do we prioritize? The highest IRRs. And so that's more of a capital budgeting thing. You're inside a, you know, you work for Exxon, and there's always like a million capital projects to do. Which ones do you pick? The ones with the highest IRR. And there's probably other, you know, criteria. I'm just saying purely from a financial perspective.
And
Yes
we
or
always
no?
talk in terms of level.
So cap rate is NOI
Unlevered doesn't mean anything.
divided by, if it's at the time of purchase, it's gonna be the purchase
You never
price.
buy anything unlevered.
But you can calculate cap rate at any time, and so it's NOI really by, you know, whatever the value is, right? So, you know, the market value in year 3 is X greater, you know, the in-place cap rate, you use value. But at the time of a transaction, it's the purchase price. Okay? Yeah? Okay. Why don't we do a little assignment in class? Easy.
Just like this?
It is exactly like this. And if you don't get this right, because we just did this, I can't make it any easier.
No, if it's like this, I'm
You've
happy.
got, listen,
Should we take a
let's
quick
let's
break?
take 20 minutes to do this, because we just did this in like 8.
Dude, can we take
And it's like almost the same.
Quick
we take a quick break before we start it?
No, because we got a lot of work to do. You can take it, as soon as you turn it in, you can take a break.
No bio break.
Can we go ahead and get rid of all of the other charts other than the cash flow chart then? As far as representing what we just did?
No, this is just a quick and dirty. I wouldn't delete any of the stuff that you've been working on.
No, I mean like as far as what you want.
Oh, for purposes of this assignment, all you gotta do is work off what we just did. You just gotta work yourself to NOI.
After this, can we ask you about the other model?
We're gonna work on development after this.
Yeah, that's what I mean. I just meant like to turn into you just want to.
All I want is, I don't want a spreadsheet with like a gazillion different, pass this on to James, please. Yeah, I don't want a gazillion different charts, okay? Alec and Chase. Yes, Chase?
There you kind of mark
I like this.
Should we not try to do this?
Try not to hard code things, if you could just. Thank you, sir. Yeah, you probably have something set up with assumptions and you can just quickly type them in. You can do whatever you want, yeah. But you don't need to use that, though. You can just use that.
Should we use which model?
You could use any one of the ones that you have, but all you're doing is solving for NOI.
I understand.
So you could use any of the ones that you have.
No, any.
You could use any of the ones, just delete all the other stuff that I'm not asking for. I'm not asking for data tables or anything like that, so you can get rid of all that stuff. I mean, you could go back to one of the elementary ones, to be honest with you. In-class assignment? I think even the numbers are like the same we just did.
Sorry, guys.
The operating expenses don't add up.
Figure it out, figure it out.
Wrapping up in the next 5 minutes. Yes.
I have a question. When I upload this, it's done this here, and then when I do I have to put, do I have to put the number? Do I have to put something so you can add it?
You're not looking at your phone and trying to figure this out, are you? Don't, please. Brian, I said no, please. Thank you.
Will the expenses be increasing by inflation as well?
Costs?
Yeah.
If I don't say that, you should.
Okay.
If you're done, you can take your break. We're going to start at 10:00. Before 3.
We can make up our, for the annual tenant sales, we make up that number, right, or the one that you used, 1%?
I think there's a number here.
Expected to grow by the inflation rate, but it just says the tenant sales are estimated at 300 square feet, but we would be taking like 1%.
You can grow 3%.
Yeah, but what we're taking would be,
That's fixed, it's a fixed amount. But if the sales go up, your fixed amount goes up.
yeah, but we make up our fixed amount.
It's here. It says it. Third
Annual.
paragraph. Miriam, you can figure out it's other.
Oh, is it 0.75%? That's what we're taking from the tenant sales?
Be wrapping up in the next 2 minutes. You only have to get to NOI, you don't have to do anything else.
Had the IRR that we did in the thing before.
You don't need to do IRR or purchase price or any of that stuff. Just the NOI, just a simple NOI, that's it. order of. I'm gonna give you guys another 5 minutes. I'm gonna start teaching at 5:03. You can work till then and not take a break, or finish before and take a break, whatever you wanna do.
I'm trying to remember for the expenses, when you were calculating it for the next bracket, you parentheses the.
So how do you inflate, how do you use the time value of money? So you multiply the base year by 1 times the inflation rate. No, 1 plus the inflation rate. Times 1 plus the inflation rate.
Maybe the 3%.
I think that's what it says there, yeah.
We're sending it to you, or what? Can we leave any of the other things? or
No, don't just delete all the other junk, or just take the tab out and save it as something and then send it to me.
Okay.
Just don't send all these huge files and then, I'm not sure what to look at. It is simple. There's no trick there. We just did it. There's no trick.
The only trick would be the pennies. No pennies on it.
Guys, Juliana, please.
Also, I forgot where occupancy fell under what category. Like for the occupancy of like the vacancy.
The general
Looking under
vacancy?
expenses, yeah, looking on the expenses.
Between revenues and expenses.
Yeah, that's right.
Professor,
Yes, Cole.
so the annual tenant sales, I know that in the one we just did, you were taking 1% of that and then adding that to revenue, right?
Yeah, we used 1% is what I used in my example. It's a different number there.
Is it though?
I think it is. If you look at the third paragraph, it is.
But it doesn't say like what percent of that.
It does on the 0.75. The top.
The
Line number
sales
3.
part,
Line number 3.
Professor, could you write down your email address so I can send it to you from my Hotmail, because I can't get into my short.
Yeah, yes, 2195.
Goes in revenue.
Yes.
The 0.75.
95 at nova.edu.
$100 on mine.
And then that's what revenue.
Oh, yeah.
Yep, thank you, John. Okay, guys, listen, what we're gonna do later, if I don't get to cover all of it, it's gonna be difficult for you to work on your assignment this week. So, you have 5 minutes. I encourage you to submit this and take a break, because I will start in 5 minutes. Yes, Kenny? I could look at it, but I
what's that rush?
'Cause I got my work computer today and I don't.
you got your work, what?
I got my work computer today and I can't connect to the internet. At least I'm trying to, but just so you know, I think.
Yeah, we'll get rid of all that other junk I don't need.
When I do that, it just gets convoluted because I started doing the inputs. So I just,
Yeah,
I
but
mean, I can
but I
highlight.
need you to send this to me.
Yeah, I'm
See
talking
you
about
later.
that.
Yeah.
Just want you to know.
It's Nova 1 or something like that.
Is there a percentage that goes with the 300, the sales?
Look at the third paragraph.
Line 3.
There's no third paragraph.
Line 3.
Oh, okay, got it. The red blocks.
Cole, there's like a bounce thing. Cole got it, now he's sending it to you, and I gotta send it to somebody else.
Nova 1.
Yeah, 'cause that's too much money. You're gonna have to reduce that by.
Oh crap, that's
You need to submit your assignments,
Why?
please.
Segundo.
Mine is pretty good.
Doesn't matter. 2 minutes. Okay, please submit them, because I gotta start, we gotta cover this material. Time's up.
Sending.
Time's up, please send.
Gotta make it pretty first.
Please send. Got it? Thank you. Please send. Yeah, close the computers, please. I'm ready to go. Let's go. Let's go, guys. Let's go, Alec. Let's go, Isabel. Let's go, Juliana, John, L'Oreal, Cole, Chase, Alec, James, Sam, Aisha, Julie, Juanita, Isabel.
It's already sent.
Okay.
Okay, let me, email. No internet. Got lost.
Sam, you sent it? We'll open up the computers in a bit, but I need eyes here first. Otherwise, we're gonna lose each other. Because we're not going into easy terrain here. Alec, let's go.
Sending the emails.
Thank you. All right. Okay, listen, so we've dealt with the major asset classes. Alec, let's go send.
slow. Oh, there it is.
Were you up? Okay, listen, we've looked at stabilized buildings, and that, just like we started with multifamily and built ourselves to more complicated income streams, now we're going outside the comfort zone of stabilized income. Now we're going into the development realm. And so, it's very difficult to do a development model, or a budget, or a forecast if we don't understand stabilized assets first. Okay? I'm gonna walk you through a hypothetical timeline in every project. So in a hypothetical world, we've got a pre-development period. We've got a period in which we're looking at evaluating something. We're on the market, we're doing diligence, we're talking to people, we're kicking tires. We're doing models just like this one. Yeah, that doesn't make sense. Next, on to the next one. So there's a period in which we're evaluating where we're going to do something. There are accounting implications to all of this, but we're not dealing with the accounting world. Okay, so, but I think using the accounting time periods give us a frame of reference. Okay, the world changes the day we acquire land, because once we acquire land, we go from a pre-development period really into a development period. Okay? At that point, everything that we're doing, Alec, please, everything that we're doing at that point forward becomes a development activity. Okay? We can closely associate the development period with a construction period, but they're not necessarily the same. So construction is a subset of the development process, right? And construction may in fact be, in certain cases, the longest component of the development process, or it may not be. Okay? You may buy a piece of land, you may need to go through a re-entitlement process, you may spend 2 years, 3 years going through a redevelopment, through a re-entitlement process. Construction may only be 6 months, but it took you 3 years to get the site entitled for what you want to build. Conversely, you may have situations where the land is already fully entitled for your intended use. You buy it, you already have plans that you were working on during the pre-development period, right? And you might be able, an industrial building, you probably get done in 6 to 9 months, depending on how quickly you're mobilized, right? You might get a simple office building in 12 to 18 months. Think about high-rise buildings, maybe you're going out 2, 3, maybe even 4 years, okay? So, I'm going to tell you that a pre-development period is kind of like a line. It could be an array in the sense that you may own a building forever. But the reality is we typically sell a building at some point, okay? So pre-development periods are generally not long. You either figure out you want to buy something or not, okay? So there might be some diligence involved in that, but I would tell you pre-development periods, unless you tie up land and spend money trying to get it re-entitled in order to develop it, and you don't close on it until it's entitled, pre-development periods are short. If you're going through entitlement, or the owner, the seller, is going through an re-entitlement process for you, it's going to take 2, 3 years, okay? Development periods, I want to tell you, 90% of the cases are going to be 9 months to 3 years, and probably somewhere between 1 and 2 years in most cases, okay? By the time you acquire the land. So, the issue is, why is the acquisition of the land important?
Money goes hard.
Well, it's not that money goes hard. Now you've got money out of pocket. Now the clock is really ticking. Now, you're spending money before that, right? But you don't want to spend real money until you got the land on your side of the books or on your side of the house, okay? So, the pre-development dollars you're going to spend are going to be minimal. So, you may spend some money on an architect doing some conceptual work and some pretty elevations, and you're not going to do working drawings until you own the land, because why spend all that money until you know you can really build it? Okay? So you've got this period. The development period ends when we have a CO, a certificate of occupancy. Okay? it may be a TCO, okay, a temporary certificate of occupancy, it may be a CC, okay? It's a conceptual period, okay, when the construction process ends. And at that point, we start what we call stabilization. So stabilization is a process or a period in which we're bringing up the revenue stream in the asset up to its full ongoing, I hate to use the same word, stabilized, situation or environment, okay? So if an office building in a sub-market is considered to be fully stabilized at 85%, during the stabilization period, you're going from 0 all the way up to 85%, okay? Now, every company measures stabilization periods differently. I will tell you, sort of by default, stabilization periods are a year. It could be less, so it could be when it's fully leased. Some buildings may not. I want to get to that in a second. Some buildings may not have a stabilization period. Why is stabilization period? Well, it's a way of defining some of the activity that's happening, okay? So it's basically while your building is leasing up. Once that building is leased up, let's call it a year after the CO, now we're in a stabilized environment. If you're a developer, you typically work under two scenarios. You build either on a speculative basis or you build to suit. If you build to suit, you typically have two alternatives. You can build to suit for sale, or you can build to suit to lease. Ultimately, the difference is going to be here, you're going to own the building or sell it to a third party. Here, you're going to sell it to the end user. Okay, so if you do a build to suit for sale, you're selling it to the end party, to the the guy who's going to occupy it. If you're building speculative, what does that mean? What does speculative development mean?
And hoping that you're putting 300 units and you're hoping to get...
You're hoping to get a tenant. You're hoping to get 100% occupancy tenants, but you have nothing in the bank, okay? So that's the realm in which developers work, okay? They're either going to totally speculate or build to suit. From a risk perspective, build to suit for sale as long as you obtain the proper credit, and you understand that there's that takeout from the buyer, and he's got the resources to do it. A build to suit for sale is a least risky type of development, right? You're building and then you got a buyer.
If you have presets.
I'm talking about commercial space right now. I'm going to talk about residential for a second, okay? So if you're doing build to suit for sale, I'm building this office building for Amazon. I'm building this industrial warehouse for Amazon, and they are going to buy it from me, okay? Sam, can we shut it, please? Thank you. This is the least risky environment, okay? Build to suit for lease is not necessarily risky if you've got a credit tenant. And at that point, what you can do is hold on to the building and produce income, or you could sell it. Cap it. We did this the other day when we did video 11 and we did a quick and dirty development model. We said if we build to a 6 and sell it a 4, we just made 200 basis point spread, huge profit, okay? This is obviously the riskiest. You're building into a market, you don't know if you're going to get tenants, and until you get tenants, you can't sell it. Most merchant developers ultimately are going to work in an environment where they either are going to speculate or build a suit for lease, and then somewhere in a stabilization period, they're going to sell a building. So merchant developers earn fees. They have promoted structures in their joint venture agreements. Their money is made by developing, getting out, developing again, getting out, developing again, getting out. Typically, developers aren't long-term holders of assets. Okay, typically. There's exceptions to that. But typically, developers, merchant developers in this country, build, stabilize, and sell. Okay?
Yeah.
When you look at this paradigm, and you say, okay, hey, I got a model for this thing. Now you got a lot of complexities because you've got a bunch of different periods here. Okay? And each one of these periods presents its own challenges in how to model. Okay? So when we look at it, I've tried to simplify it this week, and what I've done and what I'm going to walk you through is I've essentially either assumed there's no pre-development period or rolled pre-development into one concept, one timeline, one model. Stabilization is another concept, timeline, model. And once a building is stabilized, that's just what we've done. So these two periods essentially are equivalent to buying a building at the beginning of the stabilized period. So instead of putting purchase price here, we're going to add up all the costs that we've incurred up to date. Now, there's a lot of stuff that's happening here because the capital stack changes along the way. Okay? And you say, ooh. I'm going to go through some notes that I've got because there's concepts that as we talk, we continue to roll this out, I think you need to know. Okay? I'm not going to read, but I'm going to follow my thought process. Okay? Development is capital intensive. As a result of that, projects tend to last multiple years and they lend themselves to partnerships. Okay? So along those lines, it's critical, it's important to understand what our cash flows are. One, because we need to know, but two, we've got partners, okay, that need to understand that. So we use development budgets to help us understand not only returns, but also understand the cash inflows and outflows during this entire period. Okay? Because whilst we may have a building that we can sell here and be very profitable, we still got to meet payroll every week. And we got to pay the general contractor every month. And we got to pay the architect. And so not only is it an issue of overall profitability, it's an issue of cash flow during this entire period. Okay? So when we're talking about a pre-development period, it might be 6 months. We've got a development period that might be 2 to 3 years. We've got a stabilization period of a year. And now we may hold on to a building for 2 or 3 years after it's stabilized before we sell it. Okay? And we're talking now about building a model that could be 4 or 5 years in time. And we can overlay the complexity if we say, hey, we're not just building a one-off building, we're developing a project. And so that project is going to involve buying 500 acres of land, doing a bunch of site work and development, and then starting to put little buildings at different times and selling them at different times. So some of these models might have 10 or 15-year lives associated with them. And they're living documents that are continually being updated. Because when you buy the 500-acre parcel, you may think you know what you're going to develop, but somewhere once you're here, you're going to start making changes. And you're going to see one particular asset's doing well, another one isn't. You typically have some flexibility in master plan communities. You've got X number of square feet. You might be able to maybe build more office and less industrial, or the other way around. Or you might be able to, in a mixed-use environment, use more residential and less retail, or the other way around. Okay? So what we're going to do is we're going to build a model, but then that model is going to be continually living. Okay? Continually living. There's a bunch of packages out there that help us provide this, but frankly, Excel is the best tool for development models. Okay? We do use other tools. I tell you what's very practical is to use Argus to model individual elements and components. So we'll model the office building or a structure, a style of office building. We're gonna have a hypothetical 5-story, 120,000 square foot, office product, or we're going to model a hypothetical 200,000 square foot industrial building, and then we're going to just replicate those models, right? The cash flows related to each of those individual buildings along a master plan. in Excel. I'm going to show you, we're not going to get to that level of complexity here, but you are understanding what's happening is now it's not just buying one-off buildings, it's buying land and incurring a bunch of expenses that are equivalent to buying a building. As developers, the risk that we're assuming is that by undertaking this process, we're going to make more money, right, than by just buying a building. At the end of the day, with the risk associated with the development process and the lease-up, one would expect that your going-in price to the building is going to be less than buying it. So you're going to build, right, to a higher yield than the cap rate you would buy a stabilized building at, and hopefully you can sell it at a market rate where you've got a profit potential, okay? So,
what type of, and I know it's hard to say because it depends on the deal, but what type of margins are we talking?
look, I think I mentioned I think video 11, when we did sort of very quick and dirty industrial model, if you talk to institutional investors in real estate, I think they would like to have, you know, 200 to 250 basis point spread between the yield they're building to and what cap rates are in place. Or said a different way, they want to be building 200, 250 basis points above where the market rates are, the market cap rates are.
What would that be? Oh, I guess it depends.
So if industrial today is trading at 5, you'd like to build to a 7. So that 200 basis point spread gives you enough profit when you sell it to justify the risk that you've assumed. Right?
Yeah.
If you build to a 5 and sell it for a 5, if you bought a building at a 5 and sold it for a 5, did you make any money?
Lost time. So it acts like a contingency of
Well,
sorts.
inflation.
But it's not a contingency. Well, listen, inflation is a loss of purchasing power. Okay, so if you think that you're making money because there's inflation, you're getting more nominal dollars in the future, but they're not worth anymore.
Yeah.
Okay? So you can't do it that way.
What about fees that you're collecting?
Okay, so there's 2 different models. Yeah, I'm going to answer that.
The concept of
fine. I was
holding
just throwing
period
it out there.
return though would mess with your cap rate on that or not really?
Holding period return would probably not be something that you'd contemplate in
the
here.
yeah.
Here you're basically going to do, this is ultimately going to be summarized into a sources and uses statement, which is going to have a net cash flow at the bottom, and you're going to do an IRR analysis on it.
Okay.
And you're going to say, yeah, you can figure out, you can do a P&L, you can figure out what your profit is, but you're really looking at your IRR. What's my return? Kenny, my personal experience would tell you that development businesses are not profitable, are not overly profitable in and of themselves. In fact, none of the services businesses are overly profitable in and of themselves. Okay? They generally reimburse the expenses of the people that work there. I don't, let's use Styles. I don't know the inner workings of Styles. My guess would be Styles as a development construction company is not highly profitable in that business. Where they make money is the participation that the owners have in all the profits of all the buildings. Okay, so in a typical, I just kind of drew it, but I'm going to draw it again.
So they're not living off the development fees or
Pre-existing,
construction fees?
No, they're
pre-existing,
paying the salaries of all the people. There's 300 people that work at Styles. I mean, that's a huge nut to cover every month, right? You're paying expensive offices. There's no pop there. So, and again, look, maybe I'm wrong, and Terry, forgive me if I'm wrong, dude. You know, I mean, okay, all right. But my guess is, right? So Styles is going to have a development business. These guys make 5% on the total cost of a project. typically you gotta negotiate that with a client, and the client, the first thing's gonna say is, don't count land. So all of a sudden, you lose a big chunk of the development budget, okay? But you're working for 5%. So if a project is 20 million bucks, right? A $20 million project might take 2 to 3 years. You're working for 5%. What's that, $1 million?
Yeah.
Yeah, that's a lot of money, right? How much does a project manager make at Stiles? How much does a senior project manager make at Stiles?
About 50? No, I don't know.
Somebody in the office, man. A big senior project might make 300,000 bucks there, man.
Okay.
Billable.
An assistant, no, forget billable.
Take
That's
home?
what he's taking home. An assistant might make 125 to 150, okay?
Gotta get my
And
resume
there's somebody
ready.
that's worth their money. So,
Fire up my
you
resume.
figure out how much money you can make when you gotta pay 2 people to do this for 2 years, right? And you're covering office and insurance and all that other stuff.
That's not.
So is that 300 like pop or 300 over the
A year, man.
Okay.
Well,
Plus benefits.
So basically nothing, you're saying? They're not making any.
So, listen.
Incrementally, it all
Look,
adds up.
Look, I don't know anything about his business, but I know about some other ones, okay? So this is gonna cover your expenses. Hey, he's got a construction company, we're gonna talk about construction company. How much does a construction company make?
4%.
4 to 5, you know, depending on the size job. I mean, if you're doing little jobs, maybe you make 10, but 4 to 5%. Now, there's other places, we'll talk about where they make money too now, but again,
Don't give out my secrets.
a brokerage. So, how much does a brokerage operation make?
Nothing, right?
2%.
Well, okay, so the fee's 6%, right? Okay, so you're only gonna take 3%, and how much are you gonna give the actual broker?
I mean, some of them are doing like 100% commission now. Like, and they're just making money on title and fees.
I'm talking about commercial brokerage,
Oh,
man.
okay.
So in a commercial brokerage, in a leasing environment, the leasing commission's 6, let's say that it's split, 3% comes to the house, and how much are you gonna split? A good broker might take 60% of that. Okay? So now you're left with what, a 0.8?
No, 2%.
Yeah.
Really? How much do property management businesses make?
Nothing.
45%.
No, we saw, what we got it, we got benchmarks. What is property? I've said it 40 times in this class.
Like 4 to 5,
Try door number 2.
6.
The wrong way, wrong door.
No, they don't make it's
2%.
it's a headache business.
2%. So where's the money here?
This is the wrong door.
There's no money there, you're basically saying that the money's.
So what's happening is the guy that owns this, he's sitting out here, and all these projects you're building,
It's on the
he's
equity.
personally invested in. And so he personally, or she, is making the money, and this company is covering its expenses. That's the way most merchant developers work in this country.
So
okay?
he'll put like 5% here, 5% there.
Sheesh, we starting PE.
Well, it actually works, it's actually different than that, and so,
But if it's 20 million, if you're buying it at a.
listen,
20 million,
you're asking a question, so I'm gonna answer it, because you need to know it, but it's robbing from what we have to do, okay? So this developer is gonna become the general partner in a deal, okay? He's gonna put 5% of the equity in a deal. You're gonna get MetLife that's gonna come over here. They're gonna put 95% of the equity, okay? Now, what's the typical loan to value in a real estate deal that we've talked about?
70-30.
60%.
60-40, 70-30, let's say 70-30, right? So this 100%, right? This 100% is really only 30%, right?
Right.
And you got 70% debt, right? So you go out there and borrow that, right? So if the whole ball of wax is 100, right? You're gonna borrow 70, right? You're gonna put 5% of the 30, right? So it's 30, right? 5% of the 30 is, you're gonna put 1.5, right? And this guy's gonna put 28.5. So now you're looking at a deal and look how much little equity you're putting into a deal. Now, we did ROE, right? We did return on equity, right? And we said that was levered, right? And so, if you look at a project return, it may be puny when you overlay all of that, but when you've got very little equity invested, I mean, you can have a very nice return, but it doesn't stop at that. So number one, you're already mitigating risk, and you've got very little equity invested in deals. Where you really make money is with promoted interest or carried interests.
Hold on.
Okay? And so, what's a promoted interest?
Is that a promote?
Once you hit a certain like hurdle.
So this is where we talk about waterfalls, right? So now the distributions are not necessarily going to go 95-5 all the time. So what may be typical in a waterfall or a distribution in an institutional deal is that you might say, okay, I'm going to pay a preferred return on that equity. Okay, in today's environment, you might pay 7 to 8% on the equity. Okay, so as the cash is coming out, and forget whether it's a distribution or a terminal event, as the cash is coming out of the deal, you're going to pay first a preferred return. So you got 95 and you got 5. So this guy's getting 7% on his 95, you're getting 7% on your 5, right? But then you're going to say, you know, once the pref is paid, you're going to pay capital back, pari passu. Okay? In equal tranches. So first you're going to pay 7% or 8% to each. Then you're going to pay the 95 and the 5 in equal proportions. So far you haven't made anything. There's no multiplier here. All you're doing is getting your 7 or 8% return and your capital reimbursed. But now you might say, hey, you know what? After that 8% is met, we're going to start splitting 80-20. Now all of a sudden you start getting some multiplier effects, because now you're getting 3 times what you were entitled to. And you're going to say, you know, we're going to split 80-20 until this guy gets a, you know, so if we started at 8, let's say a 10% return. And once he gets a 10% return, once his IRR jumps to 10%, now we're going to split 70-30.
Good job.
Now we're talking about real multipliers here. And then the last thing you say, hey, you know what, and if you get to 15% IRR, once we've gotten enough to get a 15% IRR on our investment, now we're going to go 60-40. And this is a very typical structure in the real estate development realm today. So the little 1.5 that this guy put in, he's got all of his expenses, all his personnel's being paid, right? And look at this multiplier effect. He can wind up with 40% of the profits, and he put in 1.5% of the equity, or 5% of the equity. And that's why developers work. And that's why they drive fancy cars and, you know, have beautiful boats and, you know, whatever, fancy horses and all those other things. Okay, now,
So the real money's in the equity participation, not on the development fees and everything.
I would have liked to, so we're going to work on some things this week. We're not going to get to that. I would have liked to have gotten to the waterfall. Okay, I would have liked to have gotten here. We're not going to get here. It's overly ambitious to do that. I do promise, and I say it in the video, I do promise to do a waterfall video, and I'll send it to you guys.
I'll do that.
If you want to look at it, work your way through it, then you get it, okay?
Are those
But
videos
we're not gonna do that this week, okay? Now, in order to model what we had here, I'm going to give you an ABC step to do that, okay? ABC step, and I'm going to show it to you now. You got to get your inputs, okay? You got to get your inputs. You got to get your inputs. Garbage in, garbage out. You got to get all your inputs. Summarize them. So now we're gonna have to. If you guys remember when I went in one of the videos, I went through a multifamily budget that one of my students had given us. there were multiple tabs, okay? Now we're gonna have to work on multiple tabs. It's almost impossible to do this in one tab, okay? And you're going all over the place. You're gonna need inputs. Better to keep those on one page. You're gonna need to have a construction budget. You're gonna have to have a development budget. You're gonna have to have a stabilization period budget, okay? And then you're gonna have to get into a stabilized and reversion period, okay? And when you get yourself here, that's when you calculate your IRR, okay? I'm not there yet. There's still some stuff I want to go through to make sure that we cover all this, okay? What kind of costs are we accumulating? So when we buy a building, the only cost we have is purchase price. But when we're accumulating, when we're buying a building, we got to account for land. So not only the acquisition, right, but all the costs associated with that, and any infrastructure we got to do. We got to prepare the land underneath and top level. Okay, we got a PM and a construction company here, so we got to do all the design work, all the architectural, all the engineering. Okay, all of the testing on materials. Okay, we got to do a construction. We got to do a building. We got to come off the ground. We've got project fees, administration fees, or development fees. Okay, we've got all of the legal and financial costs associated with this, okay? And then we've got the costs associated with the stabilization period where we're not getting full revenues, okay? So a development budget is going to encompass all of these different concepts, okay? Because this is a capital-intensive business, and that is a major part of what we do in real estate, development loans come into play. Now, development loans come in a variety of different packages, okay? We can talk about what used to be called ADC loans, acquisition, development, and construction loans, or just construction loans. So the difference between an acquisition, development, and construction loan and a construction loan is that a construction loan only reimburses your construction. Acquisition, development, and construction loans help you acquire the land and help you pay some of your soft costs. Architects, engineers, testing. The problem is, since the 1980s, I haven't seen an ADC loan.
I don't think they're allowed here in Florida.
Well, it's not that they're not allowed, it's just there's a common practice not to do it. So what you may see is, you may see a land loan, and land loans are typically characterized with very little leverage. So maximum loan to value. Listen, it's all going to depend on sponsorship, right? If Wayne Huizenga, and I know he's up there too, if Wayne Huizenga came in and bought a piece of land and he personally guaranteed it, he might, at the bank where he's got all his money, they might give him 100% of the value of the land. But if you and I go, the maximum we're ever going to get, as a typical rule of thumb, is 50% of the land is going to be financed. Okay, so you may be able at the time of acquisition to finance the land, but you're only going to get 50 cents on the dollar. Okay, and then typically when you start construction, what you'll see is you will see the land rolled into the construction loan. Okay, you'll have it rolled in, and then typically what you're going to see in Florida is a construction-only loan, and a bank will only fund against your construction dollars, okay? And the way most budgets tend to work, you're going to see that, you know, when you look at, you know, loan to cost, you know, construction is rarely going to exceed that sort of 70% of total cost, okay? So what's going to happen is all your soft costs is going to be basically the equity that needs to be contributed by the equity side of the capital stack. And the construction loan will easily fund construction, but not any more than the construction, okay?
Is that why you take a co-GP so that it helps you with that?
I'm sorry?
Is that why you take a co-GP of sorts so that it helps you with that upfront cost?
No, I mean, we're saying doing a joint venture with another. Typically, the reason construction companies will do joint ventures, there's two reasons for that.
Bonding.
Two basic reasons. So bonding is probably the most important one. A particular company has a client relationship, but doesn't have the bonding capacity. The owner doesn't have the wherewithal, right? He can only bond up to a certain amount, okay?
Yeah, what does that mean?
What does that mean?
It's a performance bond.
Okay, so a lot of risks in a construction trade, okay? It's an old business, and people tend to disappear rather easily, okay? So,
Kind of like a hitman?
there's entities out there known as sureties. A surety is like an insurance company. It's like an insurance company. A lot of sureties come out of insurance companies, but a surety is not an insurance company. So an insurance company collects premiums to distribute for a common, so it's a financial intermediary. It collects premiums, like a bank collects money, right? Insurance company collects premiums to pay for when somebody in the group has a loss. That's what insurance companies used to be mutual companies, right? They weren't privately owned. It was the people who paid the premiums owned the insurance companies. There's some that are still. Northwestern is a mutual company. Florida Blue Cross and Blue Shield is a mutual company. It's owned by its members. We pay premiums, and they pay for our losses. Okay? A surety is a different situation. So a surety, there's three parties in a payment and performance bond. Okay, the surety is the one that's ultimately providing the recourse. Okay, but let's look at it in the context of a development business. You've got a construction company. And you've got a client, right? An owner, okay? So the owner hires a construction company to finish a job, but they're concerned that this guy might take the money and run, or might only work part of the time. So the client asks a construction company to provide a payment and performance bond. So the construction company goes to the surety, and the surety provides a payment and performance guarantee to that owner that says, if Alex Construction Company doesn't perform, goes out of business, not only am I going to pay you, I'm not going to pay you. I'm going to step into his shoes and complete what he was doing. So, and if you think this it happens, it happened to a project we just finished in the Gables a year and a half ago. Company went bankrupt. They're still in business. They bankrupted their Florida subsidiary. They decided to focus on the Northeast. They called us up and said, we're calling the surety and letting them know we're going to close. So surety had to go out, get another construction company, and finish the project. These are very difficult to obtain. People who work at sureties are very difficult to deal with. And ultimately, because they're on the line not only for money, but for performance, there's a very difficult vetting process to go through. And there needs to be a lot of wherewithal. A lot of construction company guys are limited, not because of their knowledge, but because they don't have the capacity to get a surety to provide a bond of a certain size for a job. So a lot of times, a small construction company has the client relationship, but doesn't have the capacity or the relationship with a surety. So they'll do a joint venture with a larger construction company that can provide the payment and performance guarantee. I drove by a project the other day. There's a joint venture between Coastal and Tishman. Coastal's a big company, but it's a big building. And obviously either they had too many other projects going on, but they did a joint venture. So you give up part of the profit, but now you've got the ability to do the job. The other reason, which might be the reason there, is you've got limits on bonding capacity. The other issue you may have is you may not have the expertise. So you've got a client relationship. You've been doing a bunch of suburban office, now you got to do a high-rise, that's outside your wheelbox, but you team up with somebody, or all of a sudden now you're going into multifamily and you never did multifamily before, okay? So, construction and development loans tend to be short-term in nature. They tend to be provided by commercial banks, and they tend to be floating rate. Construction and development loans tend to be interest-only, short-term, provided by commercial banks, okay? Variable interest rates. Notice I said interest-only. There's no payment amortization in construction loans. And in fact, because projects under construction or development are not producing cash flow, that interest payment is covered by an interest revolver or an interest reserve that's added to the loan. So the bank will loan you $30 million, and over and above that, they'll loan you another $2 million, so you can borrow from that to pay them the interest on what you're drawing down. Okay? So, there's no cash flow being generated, and that's why the banks provide these reserves. Once a project is stabilized, once you reach a stabilization period, then you tend to go and get permanent financing. So permanent financing tends to be provided more by life insurance companies, conduits, right, through securitized debt. It's changing a little bit, but that's the historical trend. Long-term loans tend to be more fixed term in nature, right? And we've already gone through some. They tend to have call protection, so there may be lockout periods, or maybe yield maintenance or defeasance or other sort of prepayment penalties associated with those, okay?
So you'll refi the construction loan through permanent.
Yeah, but there's you led me right up to my next point. There is a trend among commercial banks to do what are called construction to mini perm. Okay? So what a bank will say is they'll give you let's say a 24-month construction loan, all right? And then they'll term it out over, let's say, a 7-year period once you're stabilized. So it'll be variable interest rate up to here. It'll be interest only funded by the interest reserve up to here. And once you get to a stabilized period, then it becomes like a permanent loan. So now you fix the interest rate, okay? You put a fixed term on it, and you have some P&I amortization, okay? Now maybe you still go interest only for a couple years, and then start amortizing principal, but somewhere there is a fixing. So you've got a construction period, and then you've got a permanent period, okay? Yeah? In the context of condos, now talking about condos, what's important here is so condos are build-to-suit for sale, but they're not complete build-to-suit for sale. They're partial, right? Because you've got multiple units. Typically what happens with construction loans there is the repayment is typically pegged on a price per unit. So you borrow 100, and each unit's going to have a release price attached to it. When you go to closing as a developer, you convey the unit, and whatever that release price is gets sent directly to the loan, and so the loan is amortized not by P&I payments, but by unit closings as the project is rolled out. Okay? Make sense?
So what happens if there's a deficiency? So like, let's say there's a downturn, and the prices have to go down.
Okay, so I mean, there's a lot of nuances that go into, so that one of the reasons why you typically don't see banks going beyond 70-30 is because through most market downturns, through most, not all, through most market downturns, prices don't typically drop 30%, so there's usually enough cushion there that equity's being wiped out, but the creditor is still safeguarded, okay? But, you know, if there's a deficiency, there's going to be some sort of, you know, guarantee or enhancement there. Typically, you're going to get some sort of, you know, personal guarantee or other cost collect, or the bank's going to lose money. Okay. Now, typically, what happens is you're not going to get release prices in a way that you're going to get a deficiency. So, the way the capital stack is built in projects like this goes like this. Okay. First goes equity. Okay, so we're going up. Building's going up. First goes equity. Mezzanine financing, if there's any, and you tend to see that. So in residential projects, what typically happens is a developer's going to put in 10%. He's going to get about 10% of the total equity from the deposits from the condo owners. Okay, and he's going to get 10% from a mezz loan. Okay, and then he's going to get a construction loan for 70%. Okay, that's kind of the capital stack we've seen with multifamily developers. Okay, so first goes equity, then goes mezz, then the construction loan is last. Okay, that's why you're building the building. While you're selling, how does it go? First you pay the loan, then you pay the mezz, then you get your money, okay? So the bank is gonna safeguard to make sure that their release prices are gonna take them out whole, okay? And nobody's gonna get, they've got absolute priority, right? So they're not gonna get distributions until they're paid off. Now, there's a problem along the way, that they may adjust release prices, they may work with you, there may be a workout situation, okay? But the goal of the bank is to not have a deficiency in these. Construction costs tend to be the most important elements in a development process, okay? Typically, when you're doing construction, you hire a general contractor. So you guys can take any construction management course, but I'm going to go through a couple of things because I think it's important. Okay, a general contractor typically supervises, so that's another sort of paper monster, right? So a general contractor can work in two type ways. They can self-perform, or they can construction manage, right? They can subcontract, so they can, or some combination thereof. They may have the competency in-house to build some of the work, and they may subcontract some of the rest, okay? But you're typically going to see that that contractor is going to take the role of a construction manager and sub everything out, or he's going to self-perform. The smaller the job, the easier it is to self-perform. The likelier the chance that he's got all of the trades or most of the trades under his roof, okay? There are two typical type arrangements that a contractor is going to work with a developer with. He's going to work under a cost-plus arrangement, or he's going to work under what's called a GMP, a guaranteed maximum price arrangement. And ultimately, that just talks to who assumes a risk, okay? A cost-plus arrangement, the risk is with the client, okay? What's going to happen is the contractor's going to do the work, he's going to collect the invoices, and he's going to add the fee to it and send it to the client. The other extreme of that is you go to the contractor and you say, give me a guaranteed maximum price. Then the client says, I don't really care what it costs you to do it, I'm only going to pay you what you agreed to do. Okay, now.
Or CM at risk, which is
CM at risk is this, okay? Because he's going to give you an original budget and add his fee to it, okay? So, and I'm hearing you're not seeing a lot of those anymore, but whatever, it doesn't matter, okay? There are ways to try to mitigate risk there, right? So, you might go to the GC and say, okay, we'll do cost. Oh wait, what swings the pendulum, okay? Well, the market conditions, right? Construction's really hot, the contractor to say, you know what? Cost plus or I'm not doing the work. Contractors are dying, they'll take any job, and they'll say, yeah, I'll give you a guaranteed maximum price, okay? So the market's going to dictate, where in the pendulum you're going to be, okay? Timing-wise, this is obviously a lot easier. I remember we've worked a couple of times with people that have been good clients, and they said, look, we don't have time for you to go out there, plus we're going to be doing work along the way. So, you know what? Just do the work, we trust you. Old line relationship, okay? You can do cost sharing or profit agreements, okay, across the spectrum, okay? So you can, for example, say, let's just have a budget, right? And if you save me money over that budget, I'll give you some of the profit. And now you're motivating the general contractor to really be sharp in buying out the job, right?
You could do the same in the GMP with the